enable many people to be able to go up who could never have dreamt of going to space.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get...
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around, and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing that I mentioned and you carried on talking and ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I'm not so sure it would be the worst case scenario, but it's not going to be good. We're going in the wrong direction. If you look at the inflection of the curve of new cases, and as you said in the run-in to this interview, that it is among the unvaccinated. And since we have 50% of the country is not fully vaccinated, that's a problem.
Things are moving really quickly. That was Dr. Anthony Fauci there speaking on CNN's State of the Union from New York City this morning. Good morning. Alongside Tom Keene and Lisa Brownwood, I'm Jonathan Ferro. Here's the price action this Monday morning. Equities off session lows after China shakes things up just for a moment. We're negative 10. We're down 0.2% on the S&P. Outside of that, the bid sticks in the bond market. Yields heading south, lower. Treasuries firmer. Yields down 3 basis points to 124.45. Yeah. Euro just a touch stronger here. Euro dollar approaching 118 again, Tom. 117.97. We're positive there, 0.2%.
We're watching this, folks, to 4 decimal points, which is called pips, like Gladys Knight and the pips. And John, I'm sorry, the ebb and flow here, given the news flow this week, is important. A little bit of a worserness to it.
And this COVID infection story, Tom, is getting a ton of attention. I would say some good news out of the UK. Cases are starting to trend lower again over the last 7 days, over the last week. That's really, really important. Deaths ticked higher. They're still very subdued relative to where cases have gone, relative to where we were, say, maybe 12 months ago. But these high-profile athletes keep getting caught out. We've talked about the Olympics earlier this morning in our first word news takes. John Rahm, the Spanish golfer, tested positive for COVID during a tournament in early June, Tom. And now he's tested positive again and has to withdraw again from his second tournament in just the last couple of months. And this tournament, of course, is the Olympics. So we have these high-profile breakthroughs of individuals that have been vaccinated, and that seems to be getting a lot of people's attention as well, Tom.
It does. Let us move forward now, and we are honored to bring you, as we have for too many months, Joshua Sharfstein. He's with Johns Hopkins Bloomberg School of Public Health. Of course, Michael Bloomberg, benefactor of this television and radio program in his business of running Johns Hopkins. That's a joke, folks. Dr. Sharfstein, thank you so much for joining us. John and Lisa have a wide set of questions. We could talk to you for an hour. What's the when and where of masks for you in August of 2021? What are we going to in this next round of wearing or not wearing a mask?
Well, I would say it's probably not a uniform recommendation, given that vaccination varies so much around the country. Where there's very high vaccination rates, the rates of the virus are very low. Where there's low vaccination rates and the virus is very common, it will probably make sense for people to put masks on indoors. And that's why you're seeing some local health officials recommending that. It's just to protect people until we can beat the virus back again.
What is the efficacy of a federal approach, let's say CDC, versus every city, every town, every zip code for themselves?
Well, there's obviously a middle ground here, which is where CDC gives guidelines this is when you should seriously consider putting in place an indoor mask requirement. So it then applies to each place based on the condition of the pandemic in that area. I think that would be a good idea.
All right. Meanwhile, we're seeing protests happening around the world for some of these restrictions, saying enough is enough. If you want to get vaccinated, go get vaccinated. If you don't, why should we live our lives in fear? We are accepting our risk. We should just move on. How much, as public health officials, do you respond to these protests and you realize that we are entering a new phase where people do, at least in places like the United States and the United Kingdom, have a choice of whether to get vaccinated or not?
Well, here's the problem. People say, you know, this is our freedom. I definitely don't want to do it. It's often based on just frank misinformation. They don't understand what's actually going on. And then they get sick. And when they're sick, they don't say, actually, you know, I chose this. I'm perfectly happy to be sick. They go, what was I thinking? And I really wish I could be vaccinated. And can I get vaccinated now? That's what, you know, a physician in Alabama reported. And, you know, that's heartbreaking. And so as a public health official, you see both sides. You see people, you know, adamant that they're choosing, you know, the ability to let life go as it may. And then you see people on the other side and their families and all the people who didn't make that choice get sick. And you realize that there's a bigger picture here of community health.
There is also a question about the vaccines and the specific inoculations and their efficacy rates with respect to the Delta variant. Which is the best vaccine when it comes to protection against infection from the Delta variant?
Well, it looks like the mRNA vaccines, the Moderna and Pfizer vaccines, have very high protection against the Delta variant as long as you get 2 doses. So it's not just the first dose, very weak after the first dose. You know, from what I can tell, and, you know, I would say we need more data. Johnson & Johnson is a little bit more of a question mark, but there's some clinical evidence of protection there too. So, you know, I think being vaccinated is much better than being unvaccinated. And 2 doses of the mRNA vaccines looks to be quite protective.
Joshua, we've got to run. We've got to leave it there. Thank you, sir. Joshua Sharfstein there of Johns Hopkins, Bloomberg School of Public Health. We've talked through this morning about the risk of downgrades. That's why we started the conversation with Laurie Calvasina of RBC about an hour ago. This is Jan Hatzius and the team over at Goldman Sachs. It is a downgrade to the outlook. Quote, in the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated. They go on to say at the bottom of the first page, we have therefore lowered our 2021 second half consumption growth forecast, resulting in 1 percentage point downgrades to our GDP growth forecast for Q3 and Q4. And at the very bottom there, the line that I'm sure jumped out to you, Tom, on the outlook for trend-like growth in America, 1.5% to 2%. By the second half of 2022. So this is a sharper deceleration that the team at Goldman are looking for, Tom.
John, when Jan Hatzius visited us this 8 weeks ago, he alluded to this, but they're putting more cast in stone, chiseled in marble right now, this call. The second half 2022 sub 2% number is stunning. And John, there's one great chart. I know you've got the note, John, Exhibit 3, which is, and I want to put it in the Goldman Sachs language. Office attendance remains at just 1/3 of the pre-pandemic level in major cities. So this is it's a very complex note leading to a reduced GDP outcome.
If I was to make it really, really simple, this is about delaying the full service sector recovery. That's the issue at play here, and leading to a sharper deceleration from the peak rates of growth we're experiencing right now and what we're about to see play out in the coming quarters, Tom.
How do you fund this debt and deficit with a potential growth under 2%?
I think what you'll find, Tom, if we see more people follow the likes of Jan Hatzius at Goldman, yields are going to stay exactly where they're at. It's hard to make the argument, Lisa, if these forecasts start to build up and move in the wrong direction, that yields spike higher from here.
One of the key factors in terms of return to office and in terms of the recovery, and not to be self-serving, but is the return to schools. And can individuals who go to school, who go to elementary school, junior high school, continue to go in person? Are you going to see disruptions? Are you going to get mandated vaccinations? Are people going to be in masks? We still don't know, and we're just weeks away from the start of the year.
The risks at the end of Q3 and through Q4. We're going to build on this through the program from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Your equity market, we're down 11 on the S&P. We're negative 0.25%. From New York City, this is Bloomberg.
industry is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Here on Earth who are wondering, why are we investing all this money in space, this time in space? Talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
You have a natural just sort of slowing in sequential growth. You're not going to keep growing at 10%.
We're in a regime shift. We're going to now see growth decelerate and inflation decelerate.
Inflation has already risen significantly higher than the Fed had earlier predicted it would.
A lot of consumers are very forgiving now because they're finally being offered parole from cabin fever.
Inflation is likely to run ahead of expectations, but I think it'll settle out at around 3%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Here come the downgrades from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures down 13. We declined slightly on the S&P 500. Goldman Sachs, Tom, first out the gate with a GDP downgrade.
And Vish interpreter at Morgan Stanley goes the other way, mentioning Ellen Zentner with a calculation of a much more optimistic Q2. And I would assume then on to Q3, Q4. That's a decision, John, that makes people tune in August. Maybe we'll have more than 42 viewers and listeners in August.
Thank you for that, Tom.
Thank you.
Great promotion of this program there.
I'm working at it.
Here's the quote from Jan Hatzius and the team. In the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. They go on to say both now appear likely to take longer than we anticipated. How many other people, Tom, are in that boat?
Well, there's a lot of people in the boat, but I'm sorry, John. Morgan Stanley goes completely the other way.
We'll get into it with Morgan Stanley in a moment.
Economic recovery.
That's part of the market,
this
Tom.
Is the
That's
debate.
the debate. I'm with you.
I'm in cash. I feel comfortable.
Well, clearly, you feel a lot better about yourself, given you're not participating in what we've seen on the screen play out in the last year. Are you done?
No, did you watch Ted Lasso?
Bring Lisa in. No, we're not doing that.
They're making jokes about the Dutch, John, and I need you.
You take a drink, relax, take a deep breath, okay?
Tang.
Lisa,
even when they don't launch a rocket,
let's talk about the outlook. clearly risks are building for others to follow in the footsteps of Goldman Sachs.
The idea here, they really pointed to the return to the office and how that's really lagged behind. And Tom was talking about how office attendance remains at just 1/3 of pre-pandemic levels. Interesting, if you look at this note, there is a question about how much permanence this decline in office work really will be, that basically a much greater proportion of employees found that they could work from home more effectively and that it's proving to be stickier. But really, the proof will be when people go back to school. And I keep saying this, but I'm telling you, as a parent, it makes a huge difference in terms of your ability to leave home and actually focus.
You'll be proud of us. We talked about this all last week, and I think you're on the money here. It's a really, really important topic to discuss.
Yeah.
Because in September, the additional unemployment insurance expires, and many people anticipate the return to school to develop. Now, this is really important for how the supply side of this economy responds as well, Lisa, and I imagine that's going to be a massive part of the conversation, the debate over at the Fed this coming Wednesday.
This is a key reason why a lot of big companies, including a lot of the Wall Street banks, have pegged September as the date to restart and get people back to the office. There is a question of how indicative these statistics are showing the occupancy rate now, based on the fact that everyone is looking to that key September date to figure out what the new normal looks like, John.
Equity futures right now down 11, down 12 on the S&P. Let's whip through the price action. Negative 0.25%, a turnaround from where we were a couple of hours ago. Outside of that, into the bond market, yields pull lower just a little bit by another basis point in the last 30 minutes or so. We're down 3 or 4 basis points now to 123.95. Your euro just a touch stronger. Euro dollar 117.88. Euro dollar, Lisa, positive 0.14%.
Yeah, a bit of weakness today in the dollar. Just building on this idea of office occupancy, there's a question of how much traction the move to the suburbs has. And actually, we might get some read on that. 10 a.m., we get some new home sales. Last month, they actually unexpectedly declined based on how high the prices were. People bought fewer of them. Now the expectation is they will increase once again, and that this move to less urban regions continues. So how much does that give some steam to this idea that the work from home trend will remain in place for much longer than people had previously anticipated? This week, we do have a huge slate of Treasury auctions kicking off the week today at 1 p.m. with $60 billion of 2-year notes. I'm curious how much this says about what people are expecting from the FOMC meeting this week, culminating, of course, with that Wednesday press conference. How much do people start to ratchet back their expectations for a permanently dovish Fed, regardless of what happens with inflation? And then aftermarket, Tesla also kicking off a week of tremendous earnings, particularly among big tech names. And John, as you were pointing out earlier, a key issue will be whether they mention their relationship with China, especially in light of the new regulations, as China continues its regulatory crackdown of one of the most popular sectors in the region, John.
That's really shaking things up. And Lisa, thank you. The Hang Seng down by more than 4% at the close to kick off the week. The CSI 300 down more than 3%. Earnings season picking up big time as the week progresses, Tom.
That's the earnings front. Carl Riccadonna, always wonderful at Bloomberg Intelligence Economics. John, Biden's plan, according to Mr. Riccadonna, will be inflation light. That's like the champagne of bottled beers, Miller Lite.
Thank you, Tom, for that. Is this about addressing the supply side story?
I think so.
Is that what he's getting at? Okay, let's get to Michael Kushner, shall we? Morgan Stanley CIO of Global Fixed Income. Michael, part of the beauty of these conversations we have on this program sometimes is to get the Morgan Stanley view and compare and contrast that with another outfit. So let's talk about Goldman. Here's the quote. In the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated. Goldman go on to deliver a 1 percentage point downgrade to GDP growth forecast for Q3 and Q4. What's the Morgan Stanley view at the moment?
Well, our view in investment management is that a slowdown of some degree is not necessarily a terrible thing for the economy as a whole, in that we were growing very, very fast, with at almost double-digit pace in the middle of this year. And obviously we can't sustain that, and there's large inflationary pressures which are making it difficult to discern the underlying trends in inflation in terms of how much is temporary, how much is permanent, or raising inflation expectations. So modest downgrades in growth, a little bit longer time frame in terms of getting back to normal because of the rise of the Delta variant and more uncertainty as to how people are going to behave with this greater uncertainty, the unwillingness to increase vaccinations meaningfully in the near term, all presage that what was seen in terms of a downgrade in growth expectations in the bond market, with yields falling significantly from where they were at the end of Q1.
Michael Kushma this morning, just to get mathy, John insisted I do some math just to shut me up. And Michael, I did a 20-year regression of the 5-year real yield. I'm sorry, we have been in a trend of inflation adjusting ever lower. How do we break that trend?
That's absolutely true. It's been a combination of design policy to bring inflation down over the last 20, 30, 40 years. I remember Alan Blinder, when he was vice chairman of the Fed, talked about opportunistic disinflation as a way to bring down inflation in the 1990s. I think they've exceeded beyond their wildest dreams. But there's also been the underlying secular stagnation hypothesis of falling secular dynamics of economies bringing down that rate as well. I think what has to happen is that the Fed has to commit to trying to raise inflation by keeping monetary policy easy when things are good. This is the opposite of opportunistic disinflation. We need opportunistic inflation, which means as the economies do better, we don't respond to it, just as they over-responded in the previous periods. But most importantly is that a policy error occurred in the 2015 through 2018 period. Inflation expectations collapsed, and we need to get at least back to where we were into the 2012-2013 levels, which we're slowly getting back to. But that will be a challenge with inflation as high as it is today, to convince markets they will not revert back to any kind of behavior they had prior to this pandemic.
Michael, faith in how much the Fed is willing to allow this economy to run hot. Another way of looking at this is, can real yields go more negative? They're already at all-time lows this morning as people look at inflation picking up, supply chain issues not abating, labor shortages not abating, and a Fed continuing to be dovish and pointing to the Delta variant. Is this a trend that has more steam? Could we see 2% negative real yields?
I think it can. If they remain committed, they will not change a monetary policy. You think about the mathematics of a 10-year bond yield. It's an accumulation of 1-year yields, 1 year this year, 1 year next year, 1 year ever going forward. So the longer they procrastinate or not raise interest rates, the more downward pressure there is on long-term rates today. We estimate that if the Fed 1.65% 10-year rate would be fair value if the Fed did what they said they were going to do, raise rates to the end of 2023. If in fact they procrastinate further, where yields are today are not unreasonable, considering if they procrastinate to 2024 to raising interest rates. So the more they push out with forward guidance, when they're going to and how fast they're going to raise rates, the more yields can stay low. If inflation's still high, real yields can continue to remain very low. Can they move a lot lower? I'm not sure about that, because I think inflation is going to peak in the next couple of quarters.
Michael Kushma of Morgan Stanley, it's good to catch up, sir, as always, the CIO of Global Fixed Income. Just giving you some deeper insight into the range of views that we have on Wall Street right now about the outlook after Goldman delivered a downgrade to the US GDP outlook. With this line concluding things, Tom, for you, we expect growth to slow further to a trend like 1.5 to 2% by the second half of 22, a sharper deceleration the consensus expects. And one of the challenges that any bank has in the research department is to match that eco view, Tom, with your outlook for the equity market. Because if you believe in a sharper deceleration back to trend, what do you want to own in that environment in this equity market?
Well, the word is ambiguity, John. It can cut both ways. And I would say to a point, lower yields and everybody flips the ratio, and, it's better and good for earnings. But besides the two-part nature of the equity market, tech and everything else, there's a point where the ambiguity clicks in and goes the other way.
You could make the argument the market's already there, Lisa. The market's ahead of some of these downgrades to the forecast that might materialize in the coming weeks. Yields are aggressively lower over the last several months. Real yields all-time lows, and the NASDAQ outperformance is there for all to see.
There's a question, though, about growth and inflation. Could you get a deceleration in growth with an ongoing inflationary pressure from perhaps this increase in demand and perhaps supply constraints that are ongoing, John?
Will those supply constraints ease in the way people anticipate in the back end of this year from September onwards? Huge question for Gene Tenuzzo, Columbia Threadneedle, Deputy Global Head of Fixed Income. Looking forward to that conversation. We're down 11 on the S&P. We're negative 0.26%. You have a bid in the bond market. Yields are lower by 4 basis points on 10s to 123.62. With Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Laura Wright. China is lashing out at US policies in a tense start to high-level talks. Chinese diplomats handed their American counterparts lists of demands and declared the relationship between the two was at a standstill. China's vice foreign minister says the US is trying to contain China. House Speaker Nancy Pelosi has issued a warning. She won't back off her plan to hold up a bipartisan infrastructure bill until the Senate delivers a larger Democratic-only spending plan. Republican senators warn that Pelosi's strategy could threaten the deal. Bitcoin soared today and is now approaching $40,000. Some are attributing the rally to traders exiting bets on declines. There's also speculation about Amazon's potential involvement in the cryptocurrency sector. In the UK, the number of new coronavirus cases has dropped for the 5th day in a row. That's a potential boost for Prime Minister Boris Johnson. Following a chaotic week since the lifting of pandemic restrictions, Johnson's government has sought to encourage a return to normal life over the summer. It's dropped social distancing rules and done away with mandatory mask wearing. Banks in the Eurozone area are set to reopen the cash taps to investors. That will put them back among the region's highest yielding stocks to own. The European Central Bank said on Friday night it will let a cap on dividends and buybacks expire at the end of September. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo Minuto Nascimento, vamos levar a música aonde o povo está.
Minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem pros amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Went up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio. Curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here. Have you
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
We're about 90% of the way there. I'm here this weekend working on legislative language with colleagues and with staff, and I feel good about getting that done this week. We have one issue outstanding, and we're not getting much response from the Democrats on it. It's about mass transit. My hope is that we'll see progress on that yet today.
That is just a little hint, a flavor of the rural-urban divide between Republicans and Democrats. We'll pick up on that in just a moment. That was Senator Rob Portman of Ohio on ABC's This Week. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the market, the price action this Monday. Futures, -11 on the S&P. We're down 0.2%. Yields in 4 basis points. Just a defensive posture here, slightly defensive. Yields back down to 123.45. Dollar showing some weakness, though. Euro some strength. Euro dollar 117.93. Positive there, 0.2%. And crude on the back foot, we're down about 40 cents, Tom. We're -0.5% to $71 and about 70 cents.
Watching yield, a little fragile. I'm watching the 5-year inflation-adjusted yield. Usually I don't do that, but -1.1, round it down, I can't even do it, John. The numbers are so unfamiliar. I could never do your show. -1.92% on the 5-year inflation-adjusted yield. John,
my producer's in my ear, Tom, saying, yes, we know. You could never do my show. That's right.
Thank you.
Carry on.
I don't even know how to frame that. Right now on infrastructure, let's get to it. Jack Fitzpatrick joins us here as a debate. We're with Senator Portman, outgoing of Ohio. Jack, we forget the ancientness of this. Part of this is Senator Schumer's Gateway project in New York, and they're talking about helping or replacing 110-year-old tunnels. Do the politicians understand how silly this is? Like, get to it?
They do seem to understand how ridiculous the debate for a few years now has been on Gateway. You probably recall there was a spending deal held up under former President Trump, seemingly because he knew the importance of that project to Senator Schumer. That one individually has been less controversial now than that broader issue of exactly what the ratio is going to be from highways to mass transit. That's the latest issue we've heard in these talks. But I think you could probably argue they understand how silly some of the issues in recent years have been, because they do seem to be setting things aside and pretty close to a deal at this point.
For our listeners and viewers, I mean, I read the Zeitgeist this morning, and I'm as confused as anyone. Where are you going to put your ear to? Which door are you going to put your ear on Capitol Hill today?
The ball is in the Republicans' court, in the Republican senators. The last we've heard, our colleague Eric Wasson just reported this morning that Democrats, sort of a combination of Democratic senators and the White House, sent along what was supposed to be a holistic check every box offer. So if there's an acceptance there from Republicans, we would have a deal. The question right now is, do Republicans have any problems with any individual thing that Democrats just sent them? So the Republican senators are the ones to watch right now.
Jack, earlier in the year, we were talking about how President Biden is looking to the population to provide him support, a bipartisan coalition of Americans supporting his infrastructure plan. If you look at some of the recent polling, it's actually showed a decline in his popularity as people are concerned about inflationary pressures. How is this being reflected in the conversations, if at all, down in Washington?
In the legislative negotiations, really the conversation about inflation has been very simplistic and more of a campaign talking point. I think you see some change in the president's rhetoric, talking a bit more about inflation, trying to avoid using the kind of words you guys might use, transitory, things that might go over a lot of people's heads, and trying to address the issue. But as it plays into legislation, there's a real partisan divide just over the role of spending and taxing in this recovery from the recession. So, there's understandably a lot of opposition from Republicans where inflation concerns kind of get mixed in with just a regular old partisan divide.
Jack, surveillance correction, we do try to steer clear of transitory as well, because it is a drinking game here. And if things get a little too heady on a Monday morning, then it sets up the rest of the week perhaps a little bit poorly. There is a question, though, going forward. You talk about the willingness to borrow and spend at this moment as we try to recover from the pandemic, and yet we still are facing that debt ceiling limit, this potential for a U.S. default. How serious is that? I mean, is there actual pushback against this borrowing and spending that seemed to be the way of the future just a few months ago?
Well, the debt limit talks look very difficult right now. Of course, that's not really a conversation about the taxing and spending that happens. It's just the means of paying the bills that have already come due. But it does look like there's a lot of Republican opposition. The comments last week from Senator McConnell saying he didn't think any Republicans would support a suspension or increase really ramped up that fight. We are going to see a Republican proposal from Senator Lindsey Graham, who's the top budget committee member, saying he wants a commission of some sort to look at Social Security and Medicare. But really, it looks like Democrats are probably being pushed toward a path where they go it alone through the reconciliation process, which would be politically tough for Democrats because they really would have to own that entirely on their own rather than having a bipartisan deal where everybody takes the blame. So that's the next thing to watch, although the deadline is tough to predict, as we've heard from Janet Yellen and others.
Jack, anything on the agenda in the diary about addressing this surge in COVID infections in this country after Dr. Fauci was out on the networks over the weekend suggesting there is an active conversation about revised mask guidance?
Everyone is all ears over whether there's going to be new mask guidance, new guidance on maybe a second shot, a different dose for people who have gotten a Johnson & Johnson vaccine. I think politically there's clearly some nerves when it comes to just determining how much of a bump in the road this is to reopening. But there's so many unknowns that, when you talk to members of Congress, when you talk to people in Washington, there's as much confusion right now about how significant this increase in case counts due to the Delta variant is and how long it will last as there is with the rest of the population.
Jack, it's good to hear from you down in Washington. Bloomberg Government's Jack Fitzpatrick. And that conversation, Tom, part of the broader one for this market and for economists on Wall Street at the moment. To what degree will this full recovery in this country now be delayed?
Well, it's going to be delayed, and there's a lot of different opinions, John. I just don't think we know. And what we're going to hear Wednesday from Chairman Powell is simple. They are massively, massively data dependent. I can't emphasize that enough. And that's a data dependency overlaid with the new stew of the pandemic.
You'd have to imagine, Lisa, that Goldman's out early and others are going to follow. And also just how early this is. We'll talk about that in a moment when we get to the price action.
And I wonder how much people are going to start to talk about demographics. I mean, over the weekend, we got that the U.S. population rose at the slowest rate ever in the past year.
We've got some problems, haven't we?
Well,
Welcome back, Lisa.
You're
just
the
to
one
shine
that
a
just
light on some of them. On the equity market, down 11 on the S&P, negative
started
0.2 of 1%. With Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market, just a little bit softer. Treasuries firmer, yields lower 4 basis points to 123.29. Heard on radio, seen on TV. This is Bloomberg Surveillance.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City for our audience worldwide on TV and radio, here's the price action this Monday morning. Equity futures slightly negative, down 0.25% on the S&P 500. On the NASDAQ, down by 0.1%. Your headline through the last 45 minutes. Goldman Sachs downgrading the outlook for U.S. growth. The full service sector recovery delayed. So what have we got? A 1 percentage point downgrade for Q3 growth in America, for Q4 growth in America, and back to trend, 1.5% to 2% GDP growth in the back end of 22. That's a sharper deceleration. That's the call from Goldman. So here's the question for investors. What are we seeing play out here? Goldman early out the gate. Is this for a move yet to develop, or a move that we've already seen? Let's talk about that. Year to date, switch up the board, the Russell versus the NASDAQ. If growth is going to be scarcer than you anticipate, you would expect the growth equities to outperform, and more recently, that's what's happened. We're also seeing that play out on the year now. Year to date, the NASDAQ up by 15 percentage points, the Russell up by 11, 12 percentage points. So a little bit of outperformance on growth equities. That's what you'd expect if we were starting to talk a whole lot more about quicker, faster, sharper deceleration and downgrades to the outlook for U.S. growth. Let's go one step further, switch up the board and get to the bond market. Record low real yields on a 10-year real yield, and your nominal yield right now is pinned beneath 130 at 123.79 after having a little look at 112 last week. So yields are in again, 3-4 basis points on 10s. The curve is flatter. So, Tom, I think this is the debate right now. Goldman's first out the gate. It's leading the economists. Maybe we'll see more, but this market moved first. And I think that's the conversation we've got to have. Is the market already there in a way that the economists were not?
You bring it right up, and let me start with you instead of Seema Shaw. John, to me, it's the expectation of fixed income market, and that we all understand stocks expect out. How far out does fixed income expect?
We're going to have that debate, Tom, in a moment. Yields 123.79. Before we get to Seema Shaw, we have to get to Katie Lyons, Tom. You know the order of things. I did the market check.
I'm
Someone
new
does the
at
stocks.
this. I've been off 2 of the last 3 weeks.
I didn't mention China.
Moon River.
Let's talk about China.
Who are you talking
Katie
about?
Lyons. Morning, Katie.
Good morning, John. Yeah, let's talk about China, specifically those Chinese education companies listed here in the U.S. Yes, they were pummeled in the Asian session after China over the weekend banned them from making profit, banned them from going public if they aren't already, and banned them from raising capital. That was reflected in the Asian equities, and it is reflected in the U.S. ADRs this morning. Just take a look at New Oriental Education, down 24% this morning after falling 54% when this news was originally reported on Friday. Our analysts here at Bloomberg Intelligence say the new rules from China could mean an 80% decline in sales for New Oriental, as well as TAL Education, which is also down by about a quarter this morning, as is Gaotu. And other Chinese companies listed in the U.S., not necessarily in the education sector, are also under pressure. The fear is that this clampdown is going to lead to other industries
We already know it has come for DD Global, which is down another 12% today. One basket of stocks moving to the upside, though, is basically anything tied to crypto. Bitcoin nearing 40,000 once again at the highest level in over a month. And that is leading to a big boost for some of those crypto-related equities. Riot Blockchain, Marathon Digital, each up around 18%. MicroStrategy getting a nice lift as well. And Coinbase Global, the exchange, Tom, up about 6% at this point.
Kaylee, thanks so much. We've been talking about economic views and maybe the nuances of a house for fixed income strategists is one says tomato and the other says tomato, and they sort of move on from there. Seema Shah joins us right now with Principal Global Investor. Seema, do you care about the nuance of economists right now and how yield expects out?
I think we have a technical problem with Seema Shah, Tom. We're going to re-establish that.
Sorry.
Principal Global Investors Chief Strategist Seema Shah will be joining us very shortly. Tom, I'm with you on this call, so let's sit on it for a moment. I talked about it minutes ago. I can summarize it as follows from Goldman. And here's the quote from the team over at Goldman, led by Jan Hatzius. Quote, in the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated.
Yeah.
So Goldman's put some numbers on it, Tom. A 1 percentage point downgrade to Q3 and Q4, and a return to trend of 1.5% to 2% in the back half of 2022. And it's that sharper deceleration that they now expect. So the conversation that I think we need to have on this program with market participants is that fuel for a move in this market that we have yet to see? Or does it reinforce a narrative that is largely already played out in this market, looking specifically at bond yields, Tom, both nominal and real?
I think you've got to partition, John, bond yields, which is what I was doing there before we went to Ms. Shah. The idea of bond yield expectations versus equity, which is a separate beast. And, you know, it's not that I'm in the camp with David Rosenberg or Steve Major, but you wonder, how do you get to the yields they're talking about? And you do that with that second half view. Maybe that clicks in May of next year.
Sharper deceleration, Lisa, if that becomes a bigger theme, and I think it's become a theme, let's be clear about that over the last couple of months, you wonder where we go from here.
There's also a question about how much bond yields actually reflect what you were talking about, which is a slowdown in growth. How do you partition, to use Tom's word, growth versus inflation? Because they are not synonymous. What happens if you get a growth slowdown, but you get more persistent inflation because you don't have people come back into the workforce, and there isn't the productivity boom that people are expecting, even though you do see demand increasing based on all the cash that people have, at least for things that they can and that are COVID-proof. John, these are some of the questions that really raise an issue, especially if the stock market is being boosted by these low bond yields.
Are you just trying to tease out a conversation about stagflation? Is that where you were going? Is that what I heard? Is that where you're going? Where you were going, Lisa? Just a little bit.
Idea here.
You were saying it without saying it.
I mean, I was describing it, which I think is fair. I think this is the concern. And look, 8% GDP growth is not stagflation, but we're setting up the dynamics for a concern.
The dynamic here, Lisa, is you're incoherent because you've been hanging out on the pendulum of loons and bears.
I'm not incoherent.
Give us a bear story here. Give us a bear story.
I can give you a
I think we just got one, didn't we? Go on, Lisa.
Well played, John. Good job. Look, I'm not going to give you a bear or loon story because we have basically a huge week ahead of us, and nobody really wants to hear about the loons in Tupper Lake, which were beautiful, by the way. Really, we're having loon calls.
No, I think, look, let's get serious for a moment. If we can on this program, we have 3 hours of it. Let's just spend 5 minutes being serious.
Be serious.
The supply side of this economy and how it responds from September onwards sets the tone for so much, including for the Federal Reserve. This Federal Reserve has been so vague about what transitory means, about what substantial further progress means. They've been very vague about it, and I think some of them believe that that's a feature, not a bug. Vice Chair Clarida came the closest of anyone on that Fed board to describe the argument. And when we get a resolution to the argument, when he came on this program several months ago, Tom, and said, we'll know probably likely, and I'm paraphrasing, at the end of the year. You've got to wait for that data, September onwards, to see how the supply side of this economy responds. And if it does not respond, Tom, in the way that some people anticipate, then maybe Lisa's little bear argument over there gets a little bit more
argument.
fuel. All right?
I get it. Well, we tried to be serious as well. I would suggest, with great respect, John, I want you to bring in Seema here, but I would suggest that what we're really talking about is a Federal Open Market Committee that is more ex post than we've ever seen. John, they're going to wait and wait and wait.
Yep. Seema Shah joining us now, Principal Global Investors Chief Strategist. Seema, our apologies about the technical connections. Just having this debate here about this call from Goldman Sachs, this sharper deceleration that they now expect, and the idea that we've delayed a full service sector recovery. Are you in line with that call as well, Seema?
Hey, Jonathan. Well, we can definitely see that there's a deceleration in the second half. I don't think we're going to be looking to revise downwards our forecast. I think, most of the street all had a peak growth in Q2 is absolutely right. Now, there may be a few tweaks coming here and there, especially as we start to understand that, as we've seen from the Delta virus, that actually continued mask wearing, continued restrictions, and more than anything, probably a lack of lack of COVID confidence, which is going to be weighing on some consumer behavior going forward, may start to weigh on growth expectations. But I have to say, I agree with your point before, which is that the market has probably foreseen this. And that's what's been driving some of the move over the last month, both in the equity market and in the bond market.
Seema, when you say the market, please be specific. Are you talking about the bond market or the stock market, or are both reflecting that reality?
I think both are reflecting reality. I think the bond market has got the added issue of what is going on in the Fed's mind, which I think everyone is very much confused about. And really Wednesday, more than anything, is going to be a really good opportunity for them to clear up a lot of the confusion that's there in the market. But absolutely, I think the equity market and the bond market have been looking and seeing that growth is going to be decelerating a little bit from the first half of the year.
What do these record real yield lows mean? Ever greater negative rates. What do they mean? Not for the fancy people. What do they mean for our listeners and viewers who've got to live with this fiction?
Yeah, look, it's a concern for savers. I think that's for the normal household out there. That's a real concern. But I think that, look, we have to look at not just focusing on the short term, but what is going to go on the long term. And I do think the market has really overreacted. We all knew that peak growth is going to be hit in Q2. This is just that the market is going to absorbing it. And then once it's realized that actually it's slowing to a sustainable rate of growth, which is still a very impressive rate of growth. And then we should see equity markets both stabilize in terms of the cyclical, the value rally, and we should see bond yields start to rise as well.
Seema Shah, going to catch up with your Principal Global Investors Chief Strategist. And Lisa, you asked the question, didn't you? Which market, bonds or equities? And Seema said both. And I think you've seen that, small caps versus the NASDAQ more recently. You've certainly seen it in the bond market, that's for sure, both nominal and real.
What I was thinking about is the fact that real yields and low yields just fuels the move into stocks because they actually give you some value. So it's sort of this conundrum that the more growth expectations slow, it could be even better for equities because that means that there is that much more cash that has nowhere else to go, John.
This is something we've been talking about now, Tom, for a while. And it's interesting to me that Goldman are as lonely as they are on this call and that others haven't followed looking out. We've talked about the increased possibility of downgrade risk, and we started the program like that with RBC's Laurie Calvasina early this morning. There are enough things piling up now to suggest we'll see a lot more of the same.
Well, there's clearly downside risk in a partitioned market. Apple and Amazon aren't the rest of these companies struggling.
But levels versus rate of change, Tom. 8, 7, 9 down to 8. 8 down to 7, 6 down to 5.
Go to cash.
The age-old rumor.
It seems to be rate of change that's driving things, but we've still got to talk about some stunning levels too.
I agree strongly. You sound very old world, very British.
Thank you, Tom. I'm trying.
British.
We're down 6 on the S&P, down a little more than 0.1%. This is Bloomberg.
With the First Word News, I'm Laura Wright. The White House is shifting the way it talks about inflation. Polls show there's increasing voter concern about rising prices, and Republicans are trying to use the issue to kill President Biden's plans to spend trillions on social programs amid infrastructure projects. Democrats plan to have the president use plain language explanations and assure people the price hikes will fade in time. Don't expect those labor shortages in the US to go away anytime soon. According to a survey of business economists, only 6% expect the shortage of workers to ease off by the end of the year. Nearly a third of those responding to the survey say they don't know when the problem will be resolved. The survey was conducted by the National Associations for Business Economists. China has announced a broad set of reforms for private education companies. It wants to decrease workloads for students and overhaul a sector it says has been hijacked by capital. Education companies will be banned from making profits, raising capital, or going public. That sent shares of edtech companies plummeting. The world's largest maker of semiconductors is considering whether to expand. Taiwan Semiconductor chairman Mark Liu told shareholders the company may be building a chip-making plant in Germany. That's in addition to the one TSMC may build in Japan. Chip makers have been cranking up production to deal with shortages that have hammered automakers and other customers. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around, and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing
This
that I
is a
mentioned and you
big
carried on
physics
talking and
thing.
ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Wednesday, the Fed decides. How worried are they about inflation? What will they signal about tapering? Coverage begins at 1:30 p.m. Eastern on Bloomberg Television and Radio.
We will continue to have attractive fares for customers. this summer. The ancillaries, I believe, will continue to do well. And when we get into the fourth quarter and more likely into the first quarter of next year, summer of 2022, I think you'll see a rebound.
Ryanair looking for a profit this quarter. Neil Sorahan there, the Ryanair CFO. That stock up by more than 4% over in European trading. From New York City this morning, good morning. Alongside Tom Keane and Lisa Brownwitz, I'm Jonathan Ferro. Counting you down to the opening bound, we're shaping up as follows. 1 hour and about 42 minutes out. Equity futures down 7. We're negative 0.16% on the S&P 500. Well off the lows of early this morning. Yields off the lows of the morning as well. Still negative, still down by 3 basis points on 10s, Tom. 124.45. And the euro just a little bit stronger here. Euro dollar up by 0.2%, positive 0.2% on that currency pair. Stronger euro, weaker dollar. That currency pair, Tom, 117.95.
John, watching the VIX, 18.34. I'm going to call that sort of middle gloomy range. Not too bad, actually. Up a stick this morning. Right now, it is certain there will be a question on a conference call, and either Mr. Cook of Apple or his CFO will answer it carefully. David Wilson's out front of the simple question about Apple and China, and for Chinese stocks, David Wilson, it's not going well.
Oh, no, absolutely not. And if you really want to see how badly it's going, just look at these online tutoring companies
that all use Apple computers.
Well, they might well. I mean, consider that, those stocks, the American Depository Receipt specifically down 60% plus on Friday on anticipation of government action against the industry. And you're getting further declines today of more than 20%. Now that the government has moved, they basically said these companies can't be profitable. They have to be nonprofit. They can't have international investors. There are a bunch of other restrictions that they put on the industry, but really it's kind of just taking the heart out of the business for these companies.
Right.
And, it's part of a broader trend that we're seeing among Chinese ADRs. Bank of New York Mellon developed decades ago indexes to track ADRs. S&P now runs them, but, we're talking about the S&P BNY Mellon China ADR index. It is down 46% relative to the S&P 500 since February.
Okay, Dave, before you move on from the tutoring companies, Tom, this to me actually made me think of you over the weekend, because the issue was a lot of the Chinese officials were concerned about how much parents were spending on their children as a deterrent to having more of them because of the population, that basically the pressures were too high on the kids and the bills were just too darn high. And for some reason, Tom, that made me think of you and the tutoring bills that you talk about sometimes.
Yes, the rest of it. Tutorist David Wilson on the ADRs, I believe below $5 a share or maybe $4 a share. Institutional managers get a phone call from the general counsel, you must sell. Is that happening?
Yeah, no doubt it is at this point, and probably with the tutors started happening on Friday. But it's not just that business either. Tencent Music Entertainment, so we're talking streaming.
That's like a real company.
Yeah, absolutely. It's a unit of Tencent Holdings, a much bigger company. But the government told them, your exclusive deals with labels for songs, no, you can't have them anymore. So they've got 30 days to rewrite those. Tencent Music taking a hit in response. I mean, we're seeing declines across the board in this group. So that 46% drop since February for the ratio to the S&P 500 is going to get bigger for sure, once trading begins today.
Dave, some money managers saying that Chinese equities are becoming uninvestable because of this regulatory uncertainty. It's unclear where Chinese officials are going to crack down next, if they're willing to go after some of the biggest and most successful of their industries. Is there some sort of coherence behind some of the regulations that are being rolled out, or some sort of guidepost with respect to how the Chinese demographic is changing?
Well, I mean, what it comes down to is, the government's really trying to get, its arms around these companies. They have so much data in a lot of cases. Think about DD Global as far as that goes, an ADR that's now down more than half, basically, from where it was sold just last month when that company went public. But these are the kinds of issues that are coming up in terms of the enforcement actions. It's all about kind of reining in a whole lot of companies, especially those that have plenty of data that the government would love to see.
For those of you on radio, very important to understand, David Wilson, he's tanned and rested. This is a big week. Is this the biggest week of the biggest week, or is it sort of kind of like biggest week?
It's the biggest week. I mean, you've got companies that amount to about half of the S&P 500's market value.
Half of the market this week.
48%. They're going to be reporting. I mean, starting with Tesla after the close today, tomorrow, Apple, Microsoft, and Google's owner Alphabet, Wednesday, Facebook, Thursday, Amazon.com. Yeah, it's going to be a big week for sure.
David Wilson, thank you so much. Greatly appreciated as well. John, what are you looking at? You're looking at like the Chinese stuff.
DD pre-market down by more than 11%. I'm pleased Dave Wilson brought it up. We're trading at 7 on DD in the pre-market, Tom. We IPO'd at 14. This is a $67 billion company that's been cut in half over the last several weeks. Lisa asked the right question, Tom. Just how investable are some of these companies, given the environment we're in right now? Look, over the future, over a longer time frame, it might make sense for some people in the near term. There's some real risk in the near term.
Okay, the risk to me is not our listeners or viewers. The risk to me is a litigation stream here towards Western Wall Street.
Yeah.
That I'm not blaming them, but they've gotten run over by this.
No, you're raising questions about the questions other people will be asking, Tom. What did the company know, and when did the company know it?
Exactly.
Did they anticipate that this kind of regulatory clampdown was coming? And Lisa, if they did, why wasn't that disclosed before going public and tapping U.S. capital markets?
This is a different China, and Xi Jinping is facing a very different demographic than he did, say, 10 years ago. And there is a question of how much they will emphasize a transition to a more sustainable growth over the rapid growth, over the capitalistic emphasis earlier. And this is the key question in my mind. Is there coherence behind some of these crackdowns? Is there a move away from emphasizing success in the traditional capitalist way? And does this lead to more moves like this that pull people away from China in those investments?
This is about the party over individuals. And everywhere you look, that is what this is about. Whether it's Didi testing the patience of Beijing, whether it was Jack Ma testing the authority of Beijing, whether it's some of these companies trying to educate the Chinese, Tom, this is about party over individual and aggressively pushing back against anyone that's willing to test it.
I agree it's a story, and we should stay on it. But, John, to me, the massively larger story this week is, given the pandemic, given the uncertainty on Delta variant, what do corporations decide to do in cash? And the answer is they're going to delay.
Delay what, Tom? Buybacks, acquisitions?
Dividends, buybacks,
capital
acquisitions.
Returns.
They're just going to say, wait for October, wait for September, et cetera, et cetera.
We'll see. Gene Tenuta is going to join us next. Columbia Threadneedle, Deputy Global Head of Fixed Income from New York City this morning. Good morning, alongside Tom Keene, Lisa Brabitz. I'm Jonathan Ferro. Your price action set up as follows. Going into the Monday morning opening bell, we're down to 9 on the S&P. We're negative 0.2%. Into the bond market, yields are in 3 or 4 basis points on 10s to 124.12. 1.24% on a 10-year. Euro dollar just slightly negative here at 117.95, negative 0.2%, as Goldman comes in with the headline of the morning, downgrading the outlook and delaying the full recovery from goods to services and looking for a sharper deceleration. That call sets the stage for this debate in this market this morning on this program. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
In that decelerating upward revision pace, and about half the sectors are contributing to that right now.
You have a natural just sort of slowing in sequential growth. You're not going to keep growing at 10%.
A slowdown of some degree is not necessarily a terrible thing for the economy as a whole.
A lot of consumers are very forgiving now because they're finally being offered parole from cabin fever.
Inflation is likely to run ahead of expectations, but I think it'll settle out at around 3%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. It's a simulcast, the team complete. Thrilled that Lisa's back with us this morning on radio, on television, in not a boring week. John, the market dynamics, the opinion of many on Wall Street gets us ready for that Fed meeting.
Well, let's start with Goldman. Quote, the scope and timeline for a full rebound and the implications for the growth outlook. For the full rebound, longer. The scope for the outlook, Tom, the outlook at least means lower growth, deceleration sharper. And what does that mean for this equity market? Clearly, this is a market trading on rate of change.
Right.
The Goldman call this morning, the downgrade to the outlook, reflecting those fears.
Yeah, and the Hotsias-Zentner axis here, the polarity between Jan Hotsias at Goldman Sachs, John, and Ellen Zentner at Morgan Stanley. We can add 20 or 30 others into this debate. It redounds right over to the market. Mike Wilson, Zentner's colleague, says, look, the street says buy.
Yeah, but buy what? Buy what? He's looking for stability in earnings, Tom. That's why he upgraded consumer staples, downgraded materials. And this is the difference between the economists and the market participants. The economists are still looking at solid levels of growth. The market participants are focused on the rate of change from one quarter to the next, from 1 year to the next, Tom, from 22 out to 23. And if Goldman is talking about second half trend growth, 1.5 to 2% GDP in second half 22,
right,
and a sharper deceleration, okay, the economists might talk about really strong cumulative gains and strong levels of growth. This is a market, and it's not for me to say what the market should trade on. It's what it is trading on, and it's trading on rate of change and has been for quite a while now.
And Lisa, the backdrop of all this is, I would say Goldman is pretty lonely with a 2% sub view out, 14, 15, 18 months as well. Everyone has to adapt to that, including a Fed on Wednesday.
I was just thinking, how is the Fed going to speak to the fact that, yes, people are downgrading their view, but we're still talking about an 8% GDP. And frankly, this is not the same as inflation. Inflationary pressures persisting. And I got to say, as we see all of the 2Q earnings, we continue to see these inflationary pressures continue to build. We don't see an end to the semiconductor shortage. We don't necessarily see an end to the labor shortages, which are not closing as quickly as people expected, even with some of the enhanced unemployment benefits rolled back, Tom.
In the last 2 hours, relief in the real yield space, the inflation-adjusted yield, to go through the math, the nominal yield, the regular 10-year, less the inflation expectations gives you the residual. John Ferro, that's the real yield, and those are stunning numbers 3 hours ago.
And for many people in this market, the market is already there. Lisa's discussed it, you have, and I will now. The market's already there on both nominal and reals, and within the equity market, the outperformance of the NASDAQ reflects that. And if you want to make it really, really simple, if growth becomes scarcer, Tom, people are willing to pay up for growth. And that's what's happened with the NASDAQ over the last couple of months, never mind the last couple of weeks.
John, I'll let you do fixed income. I'm going to note in the dollar, I got a dollar churning today. Euro off the Lagarde party of last week, 117.94. Not much going on there.
Down 8 on the S&P. We're negative almost 0.2%. To Tom's point, the Treasury market is bid. Real yields, all-time lows earlier this morning on a 10-year maturity. On a 10-year maturity, on a nominal yield, 124.79. Yields in, Tom, 2 or 3 basis points.
Yeah, it's about where we are. And I also know BitDog with a run to 40,000. We're not there yet, but that's fired up the Bitcoin crew after 31,000, even 29,000 a bit away. Right now, we get an overview here of fixed income and how it folds into investment. Gene Tenuzo has been doing this for years at Columbia Threadneedle, their global head of fixed income. Gene, good morning to you. What have you changed in your view in the last week?
Hey, good morning, Tom. Thank you very much. I think there's an important element here, which is a common thread to the change in the economic forecast you talked about from Goldman, which is we need to be thinking about what is that trend rate of growth after sort of the deceleration. And the deceleration that we're seeing, while we may have expected it, it is coming a little more quickly because of the rise of this Delta variant. So I think the Delta variant's been our focus. It's an early statement, an early sentence in the Fed statement that the course of the economy will depend significantly on the course of the virus. Unfortunately, that virus has taken a negative turn, and we suspect that the Fed's path toward tapering has also been delayed.
Markets can't wait for economists over at Goldman to tell us, Gene, and I say that with the deepest amount of respect to Jan Hatzius and the team, who I love catching up with. But this market's already got the scent of this, hasn't it? This market's well ahead of this story. You look at the trajectory of bond yields since we topped out at the end of March and what's been happening within the equity market. Doesn't it just speak to this narrative that's already there, already been priced?
I think the bond market is there, John, but I think we have to differentiate between the near term and the long term. Goldman's talking about something that's, a year and a half away from now. But the Delta variant is here right now, and that's what's impacting the growth outlook for the rest of this summer and what's likely to impact the Fed's tapering decision and the logistics around that. I think when we get past that, and we will, then we will have a window where actually the outlook for the Fed is a little bit trickier because we will see ultimately some reacceleration in growth. And as we get towards the end of the year, if there's not as much slack in the labor market, inflation could still potentially be stubbornly high. So we're kind of looking at the situation we're in right now in the bond market very similarly to the summer of 2012, where real yields were making new lows at that point in time. But there's room both from a growth upside surprise standpoint and a Fed outlook standpoint as we get past the near-term issues for yields to continue to move higher.
How big of a sell-off are we talking about in treasuries?
Well, we're still looking, Lisa, at 1.5% to 2% by the end of the year. There are still some dependencies there. And of course, we need to remain on track in that reopening and see that tangible transition from goods demand to services demand. But I still think that's very much in play. And it's not unusual that after we had a 125 basis point sell-off from last August until March of this year, that we'd see some retracement. So we wouldn't be surprised to see that 10-year retrace down closer to 1%, but I do think as we get past Delta, we'll be in a better place and a higher yield environment for fixed income.
Gene, I think you're touching on something so important, just the mechanics of an economy and how it rebounds, particularly this rebound. Peak rate of change is bound to come really early in the cycle. Peak yields don't have to come with that. The pushback you might get, though, Gene, and I can characterize it as follows, that we've added so much debt to this economy that our tolerance for higher interest rates is so much lower this time around that you may have a tighter timeline between where the rate of change peaks and when the yield curve peaks and when nominal yields peak as well. What would you say back to that?
Well, I think it's a good question to raise, John, but I think we have to remember where that debt is located. A lot of the debt that was issued by the federal government to fund the pandemic relief really took the burden off of consumers, off of homeowners, and even on the corporate side where we've seen a lot of gross issuance, we've also seen corporate cash balances go up. And increasingly, we're seeing companies use that cash to pay down debt. So really, it's a government issue more than it is a corporate or a consumer issue for this year anyway. And I think, how that impacts long-term yields should ultimately add risk premium to the curve, but we're not seeing that now.
Gene, the technology companies that report this week have absurdly low levels of debt on their balance sheet. It's a cultural thing of Silicon Valley. I get it. What kind of pressure are they? What kind of pressure do they have from their financial people to do debt issuance to buy back shares?
Well, we've certainly seen it over the last decade, Tom, and we've seen that sector be a growing share of the investment grade credit universe, for example. But we have to remember that the technology universe is one in which there was not a lot of debt, a decade or two ago, because there wasn't a lot of cash flow, and that's very different now. And cash flow is very strong in a lot of these companies. So I would expect that, they would continue to sort of mature their balance sheets, and you will see usage of debt to fund all kinds of shareholder-friendly activities.
Gene, good to hear from you, sir. As always, Gene Tenuzzo, Columbia Threadneedle Global Head of Fixed Income. The credit side of the equity story that develops through the week. Huge amount of earnings coming through this week. Apple, Microsoft tomorrow, Tesla after the close. Tom, I would love, and I know you and Lisa would also love, a panel right now between Jan Hatzius and David Kostin at Goldman Sachs, just to take that eco call and then work out from David Kostin how to apply that in this equity market right now, because he came out with a note over the weekend, still sticking with some of these cyclical areas of this market, still sticking with them. So I just wonder what they think that economic call translates into a market call for this equity market in America.
I think there's a great tradition here, and some people will say, wait, you got an economist who's cautious and a strategist who's going the other way, but that is not unusual, John. The lovely panel I would like to see right now would be Jan Hatzius and Ellen Zentner. I think there's some real nuances between those two houses, calls, and many other houses as well.
David Kostin going into the weekend running the following, Lisa. Investors are concerned about the impact on economic growth from the Delta variant, but the new strain should not pose a major market risk. And I imagine most of the team, I'd assume most of the team agree with that this doesn't have to translate into a major market risk, just somewhat of a risk.
How many years have we been talking about Goldilocks? This is another case of perhaps Goldilocks persisting. Michael Kushma of Morgan Stanley saying it's not necessarily a bad thing to see growth moderate. If you have yields stay where they are, what is to pressure stocks downward, right? I mean, basically, why not go to where earnings are going up and pay for the revenue income that you're getting there and not, frankly, from treasuries?
Go on, Tom.
John, do you want to make 43% in the market?
I'll take that. Where's it coming from?
A bit ago, Citigroup went long donut, Krispy Kreme.
Okay.
And their original glaze. They say this is a new business plan.
Thank you for the single name call, Tom.
It's a single name call?
Citi.
Are you hungry?
Oh, he must be.
Is this... We're both speechless. How do you pick up from that one?
I don't know. Is that a pick-me-up, Tom? I don't know. You got a drink that requires a donut?
We bring quality research to you.
Thank you. I need to sit next to you. Sitting away from you. Just need to work out where you're going sometimes.
We need to all be in the same room together with our dozen Krispy Kreme donuts.
Down 6 on the S&P. Negative and more.
Okay, 2 dozen. I'm sorry, Lisa.
Yields are 124.95 on 10s. Heard on radio, seen on TV. With all the research this morning, apparently.
Donuts. Why don't we have a plate of donuts here?
This is Bloomberg.
With the first word news, I'm Laura Wright. China lashed out at US policies in the first high-level talks between the two countries in months. Chinese diplomats handed their American counterparts lists of demands and declared the relationship between the two was at a standstill. China's vice foreign minister says the US is trying to contain the Chinese. The State Department says it welcomes competition between the two, but does not seek conflict with China. The White House and Democrats have moved to reach a compromise with Republicans on that $579 billion infrastructure package. Bloomberg has learned that last night they made an offer covering all outstanding issues. Among those items, funding for highways, bridges, water, transit, and how much unspent COVID money can be used for infrastructure. There's a time crunch involved. Congress goes on a 5-week break August 9th. The Swiss automation company ABB has agreed to sell its Dodge Mechanical Power Transmission division to Connecticut-based RBC Bearings. The price, $2.9 billion in cash. Dodge had roughly $600 million in revenues for the fiscal year that ended in June. The sale indicates ABB CEO Born Rosengren is making progress on overhauling the company. Banks in the Eurozone are set to reopen the cash taps to investors. That will put them back among the region's highest yielding stocks to own. The ECB said Friday night it will let a cap on dividends and buybacks expire in September. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is...
up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Biggest debate happening in the business world right now is how to get workers back to work and what benefits to give your employees. Microsoft is asking employees to be back in the office 51% of the time, but you're flexible about the rest of the time. Is that a permanent policy? And for those companies that are saying you have to be back in the office 100% of the time, are they on the wrong side of history?
I think we at Microsoft, we want to be much more data-driven. I also think that in time, if a year from now, we will have more sense of what the real structural change and needs and the expectations of our employees and our customers are. And we'll really think about long-term policies based on, quite frankly, having all of that data behind us, because otherwise I think we are trying to come up and being too overly dogmatic when I think we need to be more experimental in our approach to return to work, because I do fundamentally believe the world's changed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I do not think that this crackdown will kind of mitigate the dynamism in the Chinese technology sector and entrepreneurial spirit. Don't forget, there's only one way for China to continue growth, which is innovation and technology. And with the recent backdrop, it's going to have to do it on its own.
What a timely conversation with Kei Jin, the LSE Associate Professor of Economics. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bramwitz, I'm Jonathan Ferro. Here's the price action this Monday morning, going into the opening bell, 1 hour, 12 minutes away. Futures down 6 off the lows of the session, negative 0.15%. A bid in the bond market off the lows of the session. Yields come in a couple of basis points on 10s to 125.12. Euro stronger, dollar weaker, euro dollar 117.89, positive 0.15%. If I had the border China, Tom, it is ugly to kick off the trading week. The Hang Seng down by more than 4% in Hong Kong. The CSI 300 on the mainland down by more than 3 percentage points. Not pretty to kick off the trading week over in Asia.
The hallmark of Bloomberg surveillance, as John and Lisa know, folks, is to talk to experts. We have that from the professor from the London School of Economics, and we are absolutely honored this morning to bring you David Goldman with his tenure at Bank of America, definitive on cross-asset analysis. He was way out front on the crisis of 2007 and 2008, and at Asia Times is their business editor now, a student of the philosophy and realities of China. David Goldman, is President Xi redoing Mao?
President Xi is not redoing Mao, but he is taking an important populist turn. Remember that the Chinese college entrance exam, the Gaokao, is the great equalizer of Chinese society. Everybody has a shot at it. If, however, you have massive resources put into private tutoring, in a situation where the average Chinese family already spends a year's pay on tutoring, you create a privileged class of rich people who have a much higher chance of giving their kids into a top university. So by forcing tutoring into nonprofits, he's effectively saying we're leveling the playing field. There's a broader aspect of this. Look at Metuan, which is one of the worst performers, down 14%. That's because the government said you're going to have to pay your drivers minimum wage at least. So it's wiping out the pool of cheap labor. In effect, the Communist Party is saying we don't want a situation where half the Chinese are ordering from restaurants and the other half are delivering the food. So it's a populist appeal to the less affluent Chinese, and I think kneecapping some of the billionaires who are a source of jealousy is also going to be a popular measure.
David, you and I spent a wonderful lunch at a G7 meeting 400 years ago. I think Washington was president. Maybe it was John Quincy Adams. It was a long time ago. And David, we talked about how these governments get overcome by events. What are the events that are overcoming President Xi right now?
Well, remember that Graham Allison of Harvard, who wrote a very wonderful book about the risk of a U.S.-Chinese war, said that American chip sanctions against China are the equivalent of the oil embargo against Japan in 1941. That, of course, led to Pearl Harbor. The difference is that Japan couldn't invent oil in 1941, but the Chinese can produce chips. The events which Xi is addressing is that China now feels confident in self-sufficiency, at least in the workhorse, older generation kind of chips in the 14 to 28 nanometer range. Their national self-sufficiency program has proceeded much faster than the West expected. So they feel much less vulnerable to the United States, and they're throwing down a gauntlet to the U.S. saying, stop coalition building against China. And the foreign policy aggressiveness is entirely consistent with the domestic populism. It's all part of one policy, which is China is going to be a tech superpower, but in a way that benefits ordinary people and not just a few billionaires with unicorn IPOs collecting network effects on the internet.
David, you said something interesting, that these are displays of confidence by the Chinese party, that by the PBOC, by the regulators. And yet some people are saying it's actually a sign of insecurity because there needs to be this appeal to a populist kind of feel. There needs to be appeal to masses that have been left behind by an upsurge in the capitalistic side of China that has really benefited the uppermost class. At what point does this actually exemplify weakness and not strength in terms of Xi's ruling power?
Both are true, because China has always been ruled by a technocratic elite, the Mandarin caste, now taking the guise of the Chinese Communist Party. And it's always had the problem of satisfying the requirements of a very large population. So the risk to the Communist Party is that you have an American-style accumulation of wealth with a very small number of tech billionaires in a way that leaves a great many people out. What's interesting is to look at the stocks which are doing well today. All the Chinese semiconductor fabrication stocks are up. The stocks that did the worst on the mainland are in fact luxury stocks. All of the distillers and brewers got crushed, down by 6 to 10%. So this is an expression of anti-luxury, let's say, anti-populism, with a promise to the Chinese people that there's going to be a level playing field in terms of university education. Add to this the birth rate problem. That's a biggie for China. They're talking about very little else these days. There's a perverse incentive in all of Asia where the winner-take-all system incentivizes families to place all their resources into a single princeling. Tutor him or her as much as you can and get him into a top university. That's one of the reasons you have very low birth rates all throughout Asia, not just China, but Taiwan, South Korea, and Japan. So there are a number of measures they're looking at, including on the housing side, to try to alleviate that.
David, that's a really good final point. We've got to leave it there, sir. Thank you for giving us some of your time late into the evening. David Goldman there, Asia Times business editor. Just a headline coming from Reuters I wanted to bring to you all. According to an official, the US will not lift travel restrictions, citing the Delta variant. That coming from Reuters this morning. Tom, the president a couple of weeks ago now, in fact 2 weeks ago, said that in several days we'd have some information about the travel ban, and we haven't had that information as of yet. This is a report coming from Reuters. According to an official, the US will not lift travel restrictions, citing the Delta variant.
And some of this, John, is Canada. I mean, there's different borders, there's different arguments, but Canada's there, and there's like a 20-day differential there.
The bigger issue seems to be with Europe. That seems to be the bigger issue right now. And if this is about the Delta variant, and it's already so prevalent here in the United States, the dominant strain now, Tom, then what good is the travel ban? And if the United States citizens can still travel freely into Europe and back again, what does that achieve either? They're the kind of debates that are still taking place.
They are taking place, and my eyes glaze over on it. I really can't keep track of it.
I can't keep track either, Tom. Coming up on the
country
program.
to country, I just can't keep track.
Paul Romer will be joining us, NYU professor, Nobel laureate, and former World Bank chief economist, on an important moment again for the global economy. Yields are lower by a couple of basis points to 125.29 on 10s. Your equity market down 6 on the S&P 500, negative 0.14%. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Heard on radio, seen on TV. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep. So stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Four-day winning streak coming into Monday on the S&P 500 from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. 60 minutes away from the opening bell this Monday. Here's the state of play on the equity market. We're down 7, negative a little more than 0.1%, down by 0.15%. Yields come in a couple of basis points, down 2 to 125.29. Euro slightly stronger against the US dollar, 117.88. That currency pair positive, 0.14%. And Tom, crude unchanged, back with a 72 handle, $72 and about 5 cents on WTI.
It's a terminal screen looking for market news, and maybe we'll get some of that news in the economic data and then to the Fed meeting on Wednesday. We start strong in this week of technology earnings. You do that with a laureate from New York University, Berkeley, Stanford, Rochester, and I think from Chicago as well. Paul Romer joins us now. We are thrilled to have him with us today on technology and what it has done to us. Professor, I want to go back to 1989 when you stopped the economics profession with human capital and growth, and then you went on to the technology inside our system, the endogenous technological change. How do you look at these 4, 5, 6 ginormous companies and what they have endogenously done to us?
Yeah. You know, it's a very interesting story. The technological progress has been enormous. Better chips, better software, better devices. The effect on society has been ambiguous. We've had many good things, but also some bad things. I think that the bad things all trace back to this pivotal decision by Google, followed by Facebook, to switch to the advertising model, the targeted advertising model. This has had all kinds of repercussions that we're now living with, like another wave of the pandemic driven by vaccine hesitation that's been fostered via social media. So we've combined enormous technological progress with a really bad business model, and we're paying the price.
Should we break up these companies, and to be narrow about it, if you can take Amazon with cardboard boxes, the cloud, and a burgeoning advertising business, as you mentioned, is it Standard Oil of New Jersey?
Well, I think first, I worked on the government side of the Microsoft case. I actually helped, design the proposed apps-ops breakup of Microsoft, which the judiciary just rejected at the appeals court level. I think it's extremely unlikely that a judiciary that's even more conservative now is going to approve a breakup of any of these firms. I think we just have to be realistic about that. So what I think we need to do, instead of focusing just on breakups, or at least government-forced breakups, is to change the incentives to get them to shift away from this targeted advertising, surveillance, spying kind of model, and to go back to the old-fashioned model where people pay to get things. So we could use things like the tax code, as I've suggested, to create incentives for firms to stop relying so much on advertising and to rely much more heavily on subscriptions, the way Netflix does.
Paul, is this tech dominance related to the stickiness of the high unemployment rate, of the stickiness of the low participation rate that we're currently seeing in the U.S. labor market?
Yeah, I don't think so. Reasonable people can differ, but I don't think this is the problem. I think fundamentally we've been for 20 years now in a mode where the Congress wasn't able to do anything. So all of the work fell to the Fed. We used very low interest rates as a way to try and recover, but that meant that we ended up not recovering fast enough and far enough, so that we've steadily ratcheted down the key metric I think we should be watching, which is the employment rate for 25 to 54-year-olds. So what we need to do now, and what we seem to be headed towards now, is something more like what we saw under Reagan, which is very aggressive, loose fiscal policy, stimulative fiscal policy, and as needed, tight monetary policy to keep inflation in check. So I think that we just have to recognize that it takes a long time. It's a slow process to get people back into jobs. We just got to keep pushing on this recovery long enough to get back to where we should be, which is with a lot more people who are employed.
Paul, I want to stay on this point for a minute because there's been a lot of question around how much the enhanced unemployment rates, enhanced unemployment benefits, I should say, actually contributed to the stickiness of the participation rate remaining so low. There have been a number of studies that have challenged that. Other people saying that, look, the economy has not gotten back on. You still have people who childcare is still an issue. So what is the main why behind the stickiness right now at this point in the pandemic?
Yeah, I mean, if you look back at, say, the recovery from the recession in the early 2000s, getting people back into jobs is a slow process. It's very easy to kick people out of jobs. That happens very fast. And then remaking these matches between employers and employees just takes time. And so we have to be realistic in our expectations about how long that takes and maintain the conditions to keep getting people back into those jobs for as long as it will take. And it will take, I think many months to recover to the level we need to be at. We just have to be sure we don't give up too soon.
Paul, there's just all sorts of ways to go here. In the limited time we have left, I want you to talk about what everybody in this pandemic's gone through. And Greg Gilman at Yale University talks about it, the interiority of technology, how we're all sitting in our bedrooms or hunched over our computer doing computer stuff and not being social. Is that the ultimate risk to the United States? Are we going to be as lonely as Tom Keene, John Farrow, and Lisa Abramowitz?
Yeah. Well, somebody told me that the new acronym is FOGO. Instead of FOMO, fear of missing out, now it's fear of going out. So I think we're all suffering a little bit from this experience. But I think there's a kind of a realization which is coming, which is that these tech companies have benefited enormously from our greater reliance on them. And these tech companies are causing the problems we're seeing with vaccine hesitancy. So I think there's a backlash brewing against these firms. I don't think it's going to show up through a breakup via antitrust. I do think we're going to see legislation that reins them in.
I think, folks, again, this is the book, The End of the Myth by Greg Grandin, which is just a fabulous effort. Can't say enough about the history of this. Professor Romer, is where we are right now, like maybe we were with the railroads in 1930? I'll let you choose a technology. But this bouncing off of technology that we're all doing on a week of technology earnings, is that where we are right now as we've been before?
Yeah, I'm not sure that there is a good historical analog for what we're dealing with right now.
Yeah.
There's a very good story out in the New York Times this morning about disinformation for hire. These platforms have created weaponry which is now available for purchase for anybody who wants to go out and create disinformation. There are some echoes of the period of yellow journalism here, but the scale of this and the speed with which these new platforms of propaganda and disinformation can operate is something we've just never encountered before, and I think it's very frightening.
Paul, just to wrap this all together, I'm curious about whether we could see some sort of China-like moves in the United States when it comes to regulatory crackdowns on big tech, on control of data. And this is actually something that surprised markets with respect to how ferocious some of these moves and dramatic these moves have been over in China. Is that a purely idiosyncratic move, or does this set the stage for the U.S. to take similar, albeit perhaps less dramatic moves?
Yeah, no, I think there's a very close parallel. Everybody thinks about how different we are from China, but in many ways our circumstances are very similar. We're on the verge of having platforms and companies that are so powerful and so influential in the political process that they're ungovernable, that they're beyond the rule of law, that the state can't actually get them to comply with the law. China has realized that this poses an existential threat to governance and law, and they've decided they have to stop it. We haven't gotten there yet in the United States, And I hope we get there soon, because the more influential these platforms of propaganda become, the harder it will be for us to reach a political consensus that we have to do something.
Professor, fantastic to get your views on this program. Paul Romer there of NYU, the Nobel laureate and former World Bank chief economist. Some of the longer-term issues we've got to grapple with. Let's deal with some of the nearer-term ones. This Wednesday, a Federal Reserve decision and news conference with Chairman Powell. This from Deutsche Bank. The incoming data will dictate the exact sequencing for the Federal Reserve. The risk relative to this expectation is that the June CPI inflation surge motivates the committee to accelerate taper talks, Deutsche Bank goes on to say, and send a clearer signal that tapering could be as early, Tom, as September.
Are they going to do that with a pandemic news flow, John?
I think that's the big question, Tom. I think that's the big question. How do they grapple with the
I don't
incoming
see it.
information? Does the data make them accelerate the timeline? Or, Tom, dare I say, is it the outlook? Is it the outlook that's going to change things for this Federal Reserve?
And it's going to be made up here Monday, Tuesday, and into Wednesday as well. Matt Lazzetti over at Deutsche Bank, John, as well, you know, on this goofiness and this parlor game of where growth is. He's got a more optimistic view than Goldman Sachs out to 2022, even into 2023. But again, he goes below potential way out in 2024.
I'll speak to a big bull in just a moment. In about 20 minutes' time, I'll catch up with Michael Purvis of Tallback and Capital Advisors.
He'll push
founder
against it.
And CEO. Michael Purvis, Lisa, upgraded his target when you were away to 4,800 on the S&P.
Coincidence? Coincidence?
Because you were away?
Yeah, because, you know,
Is
you
it a
didn't want the
coincidence that we have
bearish
record low
bond
real
yields
yields on a 10-year this morning with you back?
I don't know.
Welcome back. It's good to have you back, Lisa.
It's good to be
I hope you're nice and rested, because this week is a busy one.
It is.
With Lisa Bramford, Tom Keene, Jonathan Ferro. For our audience worldwide, heard on radio, seen on TV, with your equity market just a little bit lower, this is Bloomberg Surveillance.
With the First Word News, I'm Laura Wright. Well, Jeff Bezos has followed up his trip into space with an offer to NASA. The world's richest person wrote to the space agency and said that it must quickly return to the moon. And he said he would waive up to $2 billion in fees as it competes with SpaceX for NASA's Human Landing System program. The White House is shifting the way it talks about inflation. Polls show there's increasing President Biden's plans to spend trillions on social programs amid infrastructure projects. Democrats plan to have the president use plain language explanations and assure people the price hikes will fade in time. China has announced a broad set of reforms for private education companies. It wants to decrease workloads for students and overhaul a sector it says has been hijacked by capital. Education companies will be banned from making profits, raising capital, or going public. That sent shares of education tech companies plummeting. The world's largest maker of semiconductors is considering whether to expand. Taiwan Semiconductor Chairman Mark Liu told shareholders the company may build a chip-making plant in Germany. That's in addition to the one TSMC may build in Japan. Chip makers have been cranking up production to deal with shortages that have hammered automakers and other customers. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
I've always sort of pictured what it was going to be like. I mean, you know, like the ride up there, the ride back. And I never realized that the whole experience was going to be so vivid.
But beyond sort of the satisfaction of your own goals being achieved, what does today symbolize for the company and also for all those children that were present earlier?
Well, look, for the children, we've just got to get building as many spaceships as we can, as fast as we can, so that one day those kids will have the chance to have the similar experience to what I had. And that we will do. We also launched this giant global raffle today, so that, you know, 2 kids for, you know, just $10 for a pair of tickets. If they could win the raffle, they can go up. But that money will hopefully enable many, many people to be able to go up who could never have dreamt of going to space.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing that I mentioned and you carried on talking and ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
Valuations, particularly, you know, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We don't find any kind of rejection from our population regarding vaccines. This week we reached 52% of our total population with that is fully vaccinated. We expect to before the end of the summer to have 70% of our population fully vaccinated.
The Prime Minister of Spain, Mr. Sanchez, there with an update on what Spain is doing. They have had huge challenges, I know, in Barcelona, among others, and that speaks to the regionalization of what we see in this pandemic. On that moment, for the United States, Lloyd Minor joins us now to say he's with Stanford University and their School of Medicine dean. Barely describes his original research in medicine and also his academics. We're thrilled that Dr. Minor could join us today. Dr. Minor, a federal judge stood up last week and said Indiana University can force people in some way to get vaccinated. I know at Stanford you have a sterling record. I believe it's 257 illnesses, which is remarkable given the size of Palo Alto. But what is your policy? Are you heading towards where Indiana is?
Well, good morning, Tom. It's good to be with you. We do have a policy requiring vaccination for all healthcare workers and also for students at Stanford. There are provisions for people to apply for exemptions based upon medical or religious reasons, but we strongly encourage people to be vaccinated, and we're seeing a very high number of people in our system who are vaccinated.
That's right where I wanted to go. If you have that policy from someone of your repute, or frankly, Indiana University as well, do you see action on the part of the unvaccinated?
Yes, we do. Roughly 85% of people in our healthcare delivery system today are vaccinated. That number may be larger. We're still collecting the data. And that it continues to increase every day. I think vaccine hesitancy is coming down. We're seeing just how effective these vaccines are. And of course, with the emergence of the Delta variant, vaccination is even more important.
Dr. Miner, our colleague John Farrow pointed to a headline this morning out of Reuters, an exclusive report by them saying the U.S. will not lift travel restrictions, citing this Delta variant, saying it is too early. Does this make sense from your perspective based on the science?
It's always hard to know when to impose restrictions on the mobility of people or the activities of people. Certainly the Delta variant is more transmissible, but we do know that the vaccines are highly effective at preventing severe disease from the Delta variant. You know, over the past several weeks, over 99% of the deaths in the United States from COVID-19 have been in unvaccinated people. So while there is still a risk of infection in people who are vaccinated, the disease is typically much less. Now, also, we know that masking and observing social distancing are effective measures as well. I think the decision on when to impose a travel restriction is one of the most difficult decisions our government leaders can make. I think the more we can do to keep track of the pandemic, where it's spreading, where it's receding, will help to inform those decisions.
A very diplomatic answer, Dr. Miner. There is a question also going forward of what we ought to be tracking in order to understand that we can open up our borders, we can open up some of these restrictions in full in a comprehensive and frankly united way. Is it fair? Is there a threshold of hospitalizations or death rates that we can look to signal that perhaps we have the all clear and can go back to life as normal?
I think you point out the critical point to monitor, and that is hospitalizations. We know that what happened early in the pandemic, the tragedy in New York in April and May of last year, that was related to the healthcare delivery systems becoming overwhelmed, not enough hospital beds, not enough ventilators, in some cases, not enough oxygen. We can't allow that to happen again. We're going to continue to see mild to moderate illness for weeks, months ahead, because this pandemic, the virus continues to mutate. There are more transmissible forms that emerge. So it's going to be we're going to be living with COVID for a long time, but we have to make sure that we don't overwhelm healthcare delivery systems.
When I look at this, I look, Dr. Miner, at a nation, as Tocqueville talked about, which is anti-intellectual, anti-science. And I know every other nation has the same challenges as well. Stanford is one of our resources of science, and I mean that in a philosophy sense. How do we shift this philosophy in America?
Well, I think there's a big responsibility for those of us who are in science and medicine to be better communicators than we have been in the past. When we don't know something, we need to say that we don't know it. We also need to help people understand what the process of gaining evidence is. You know, no one, I think, very few people 2 years ago would have predicted that something like COVID-19 would happen in our time, and it did. And we're still learning about rates of transmission, how the virus changes over time, and what can be done to prevent its spread. We do know, however, that the vaccines that have been developed and given FDA emergency use authorization in the United States are among the most safe and effective vaccines ever to be deployed.
We have to leave it there. Dr. Miner, thank you so much. Lloyd Miner with an update, an important update from Stanford University as well. Lisa, I want to go back, I think it was 2 hours, to your comments on school. All of a sudden, on a Monday morning, I'm seeing in the zeitgeist a little bit of study of where are we in 14 days.
Honestly, to me, this is one of the biggest unknowns out there. If we can't get kids back in school in person and we can't get healthcare and childcare back to where it was before, how can people go back to the office?
What do you do with kindergarten?
Well, I think that increasingly, especially the younger children, look, just from my background and my family, frankly, as early childhood educators with a number of them, it's incredibly important for it to be an experientially driven, really in-person moment for especially the younger generations.
Surveillance every day.
Exactly. I want to just bring up something else because I'm shocked that you have not brought it up earlier.
Right.
Bitcoin rallying. surging past 40,000.
We've touched it, and I mean, it's out there. Joe Weisenthal's doing up a storm on Twitter about it. I don't know. I can't understand his tweets. I don't know what.
I think it's fascinating.
No idea what
so
he's doing.
here, you've got, first of all, the negative real yields, and when they go more negative,
Yeah.
people tend to go into Bitcoin, so that's one aspect of it. But the other one is that Amazon.com posted a job listing for a digital currency and blockchain strategy head. And so people are speculating that they could get into this, and that's enough to prop up the price. And then other people are saying short covering. I think it's interesting, the idea of the adoption. I mean, Venmo increasingly even having a digital currency checkbox.
38,000, pushing 39,000 on BitDog. Maybe we'll get to 40,000 all clear. Up will go, moonshot to 60,000.
You're not excited?
I'm not on board. Matt Miller's loaded up to his eyeballs on Bitcoin.
No, he gets very excited. I just thought you'd want to talk about BitDog.
No, it's there, and you know
It's
it was 29,000 when you were with the Loons and the Bears. Loons and the Bears demand a data check. Futures -11, Dow futures -102 off those record highs that we saw on Friday. The VIX 18.57 as well. Coming up on Bloomberg Radio and Bloomberg Television, good conversation, including with Ambassador Haas, 12 noon. With David Weston. Stay with us. This is Bloomberg. Good morning.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Here on Earth who are wondering, why are we investing all this money in space, this time in space? Talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City for our audience worldwide. Good morning, good morning. Let's get this trading week started. Equity futures down on the S&P by 12 points, negative 0.33%. From New York, we begin with the big issue. Looking ahead to a big week.
The level of volatility.
Volatility and skew is high. You're going to see market volatility.
It's the surprise factors. Earnings are coming in.
GDP is also expected to peak.
What data do you look at?
We're in a regime shift.
Economic activity looks like it's slowing.
Inflation has already risen significantly higher.
What is the Fed going to do?
The Fed is in control of the curve.
You'll hear some conditioning of markets to expect tapering,
but low expectations.
No matter what they do, still a very dovish message.
Of course, it's what the market anticipates versus what it gets.
Joining us now is Esty Dweck of Natixis, Michael Purvis of Toolback, and Keith Lerner of Truist. Guys, great to catch up with you all. Esty, I want to start with you and get straight to this call from Goldman Sachs this morning. And I'm going to bring up the quote to start the show. In the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated. Goldman downgrading Q3 and Q4 by 1 full percentage point. Now, we'll talk about the levels in just a moment. I want to talk about the rate of change. Esty, your view on what Goldman has come out with this morning.
It's not a surprise to have a downgrade in some of the growth expectations. We've seen throughout the last 18 months that people have some degree of self-discipline. So when fears of COVID, of a variant, get a little bit too high, people pull back on service consumption. So it isn't completely surprising. I think growth is going to stay stronger than people expect. The retail sales remain very strong. The amount of excess savings in people's wallets is enormous. And I think that's going to continue to support growth into the third and fourth quarter. And that also means that we haven't completely priced in this reopening, and there's more room to go in the reflation trade.
Michael Purvis, your reaction.
I would agree with that. I think what the market needs now is not great Q2 economic prints. What the market needs is 2022 momentum going into 2022 that's going to be strong. So if some of these COVID clouds, if you will, if some of the supply chain bottlenecks actually ends up deferring growth into next year, that's exactly what the equity market wants and needs right now.
Well, let's talk about the 22 call. Here's the quote. We expect growth to slow further to a trend like 1.5 to 2% in the second half of 22, a sharper deceleration than consensus expects. Now, Keith, you can look at the overall numbers for Q3 and Q4, and the levels are still really solid. But this has been a rate of change story for this market for quite a while now. And if we're talking about a sharp deceleration into the back half of 22 of 1.5 to 2% GDP growth, what would that mean for you?
Well, first, Jonathan, good to be with you. We're not in that camp, number one. We think that we're going to have above trend growth through next year. And of course, with some of the COVID numbers, you expect some slowdown. But I would say that I think the markets already has been telling you this, and a peak in economic growth does not necessarily mean a peak in stock prices. Look back at the last two cycles. We saw peak growth in 2004 after the first year of a bull market. We still had several years left. If you go back to the last one, the financial crisis, peak ISM happened around 2010, and we had several more years going forward. And then, like I said, look at the market already. Think about small caps as a good example. Small caps earlier this year were beating large caps by 20%. This is as of March. As of today, they're flat. So I think the market's already factored a lot of this in. I do think we'll have some sloppy trading as we get through this. But overall, you also have to remember, we're still relatively early in this economic expansion at 1 year versus the average of about 5 years.
Yep, you're right to bring up the NASDAQ and play it against the Russell. Right now, year to date, the NASDAQ outperforming the Russell. And that development's taken place largely over the last couple of months. And Esty, I'll ask that question of you. This call from Goldman about sharper deceleration. Some people might respond this morning and say the market's already there. Real yields record lows this morning on a 10-year maturity. Nominal yields have corrected off the highs from the back end of March. And we've started to see the leadership over the last couple of months move away from small cap cyclicals towards big tech again. Wouldn't it speak to that theme already being priced in this market?
Absolutely, and that's why I think the surprise is going to be to the upside in terms of growth. We've seen a number of different fears impact investors over the last few months. Obviously, inflation earlier in the year, then growth, more recently the Delta variant, and that dies into the growth story. As data prints remain solid into the next few months, over the summer and into the fall, we're going to get this confidence that the recovery continues. It hasn't been stalled entirely by the variant fears. We need hospitalizations to remain manageable and contained. But that's why I think now the market, as you say, is already pricing in some kind of deceleration. And yes, Q2 might be the peak in growth, but I agree this is going to be a long cycle. Growth is going to stay above trend for quarters ahead of us. And so the surprise is probably to the upside.
Michael Purvis, you're at 4,800 on the S&P 500. Where does the leadership come from within that call?
Well, I think it's always important to know that even if the economic trajectory is a little weaker, big cap tech will get a bid there. It's sort of like the quiet backbone of this market here. And to be a little bit conditional on your question, John, I think I expect there's going to be a lot of leadership from value and economics as well. Like sort of a tag team, and really in a sense, I'm still quite constructive on reflation equities here. I think it's going to be a little bit trickier here, and I think there's a little bit of misinterpretation of what the bond bid is telling us as it relates to reflation equities here. But I think you need big cap tech exposure here there, but I think you may well see some excellent performance from reflation equities.
Mike, let's pick up on that just briefly. You mentioned the bond market misinterpreting things. What did you mean by that?
Well, I've had this bullish bond market call from late March. I thought yields were way overdone when they've gotten up to 1.75%, and I was calling for sort of a pivot in the trajectory of bond yields, but I wasn't calling. It really wasn't an economically bearish based call. It was really simply that it was really a reflection of Fed policy, what it was likely to do over the next several years, and in a sense, John, the 10-year Treasury note kind of jumped to sort of some late cycle levels and sort of behavior, whereas I thought equities and many commodities were sort of still in the early to mid cycle, and that's created a lot of confusion here. So I don't look at the bond bid, 10-year at 1.25. I don't look at that as an indictment of 2021 or 22 growth. I think it was really a coming to terms with the Fed market. You have to understand that the Eurodollar futures curve steepened into 2024 by 100 basis points since the Georgia election in January, and the 10-year went up by 100 basis points. And then that same Eurodollars curve flattened by 50 basis points, and the 10-years come in by 50 basis points. So this whole gap between where the Fed's was going to be in a couple of years versus what the market thought or expected the Fed to be, I think that gap has been closing, and I think that's everything you see in the 10-year is completely logical and rational, but it's not an indictment of growth in the next couple of years, which is what inequities really need to look at.
Let's debate where the Fed's going to be and bring in Michael McKee, our international economics and policy correspondent. Mike, what a week ahead we've got.
It's a very busy week, especially if you're a Treasury trader. I mean, you look what's happened over the most recent weeks. We call it, at least the Bank of America is calling it, the Delta Dilemma. The MOVE index that tracks from Bank of America and ICE tracks bond volatility way up, and the yield curve way down. How do you square those two things, and what's going on with that? Well, you're going to look at a very busy week for bond traders because you've got not only end of the month and summertime volumes, but you've got the Fed meeting on top of that, and that's on Wednesday. But even before that, we get new home sales, tell us something about prices. We got home prices, a couple of different indexes on Tuesday, and then you have the Fed. How do we trade after that? Well, on Thursday, you get some new data on GDP, and you were referring to that with the Goldman Sachs call. Friday, the PCE inflation numbers. So whatever you do at 2:30 on Wednesday might be eclipsed by what comes out on Thursday and Friday. We are not expecting the Fed to really do anything on Wednesday. It's a question of what Jay Powell says about where we go from here. And what's interesting is you look at what the Fed is doing, buying $120 billion a month in QE. Do they need that anymore? Mohamed El-Erian is pressing them to stop. And take a look at this chart from our Ira Jersey, who notes that the rise in the Fed's balance sheet is basically all being recycled back to the Fed now in the reverse repos. There's plenty of liquidity out there. Do they need to keep going? Could the Fed chair suggest an earlier taper?
Mike,
to watch for.
You've asked the question repeatedly, what do we get for 120 billion every single month that we wouldn't get for 60, 50, 40, 30, 20, 10? Maybe even zero. Mike, good to catch up. Looking forward to the week ahead, that's for sure. Mike mentioned Mohamed and what Mohamed El-Erian had to say about inflation recently. Take a listen to this.
I don't think they quite appreciate what's happening at the company level. I have a whole list of companies. You've covered some of them that have announced price increases, that have told us that they expect further price increases, and they expect it to stick.
Esty, I have to say, the distinction between what you hear from the C-suite in America and what you hear from Federal Reserve officials on the FOMC, there is some daylight there. Esty, from your standpoint, weigh in on A, the transitory argument, and B, when you have a conversation with clients, how you define transitory, what this argument's all about. Do we even know what it is?
So it seems that that has become the question: how long is transitory, or how quickly does inflation have to recede for people who've said it was transitory, like myself, to be correct, and like the Fed? I still believe that inflation is transitory in the sense that a lot of the upside to inflation recently has been due to pent-up demand, to one-off factors, to supply chain bottlenecks, and most of those will and should gradually ease into the end of the year. That said, inflation is probably going to be higher for longer than we'd previously anticipated, and that's probably the case for the Fed. That's probably, in my opinion, the only thing that really changed in June was the Fed saying, we're not asleep at the wheel, we are keeping an eye on inflation, but that doesn't change the tapering or the rates picture. It just means we're having a look at it. It'll stay higher into the end of this year, then it should gradually retreat. When you look at the bond market, when you look at yields, it does seem like the market's come to that way of thinking as well, that yes, inflation might stay higher for now, but it isn't going to spiral. And especially if you have these growth concerns coming in for the end of this year in 2022, you can't really have an inflation scare at the same time.
Keith Lerner, your reaction.
Well, I think the first thing is, if we're going to have the best economic growth in decades, we're likely to have higher inflation than we had before the pandemic. So a lot of these factors are transitory, but because of that stronger growth, and we're in a different view than Goldman, we think that growth stays stronger for longer, and therefore, inflation will come down. It won't be runaway, but it will likely stay above the previous trend. We're already seeing things like used car prices start to come down. I do think that rents will be a bit stickier. I think oil will be a bit stickier as well. But also going back to the Fed, I mean, it is kind of a difficult situation because at the same time, with the COVID numbers going up, we actually think they're likely to push the tapering into next year.
Interesting.
And then by next year, what's going to happen is we'll have the reverse, where the comps, the year-over-year comps, or the base effects will actually be working in their favor to give them more room.
Michael Purvis, final word.
I think the other facet of this inflation discussion is after some of these, sort of extended transitory inflation surges mellow out, like we saw lumber collapse, for example, hand sanitizer, right? But, let's go forwards to 2023, 24. How much technology is going to exert strong deflationary trends just into a period when Powell's supposed to, in theory, be hiking aggressively? I think that's a very important and unknowable discussion topic right now.
Yep. Michael Purvis alongside Keith Lerner, together with Esty Dweck, sticking with us Let's get you some stock price action, shall we? Your equity market looks a little bit like this on the S&P. We're down 9 on the S&P 500. With your movers, here's Abby.
John, just a little bit of a risk-off tone today, and that, of course, has bonds bid off of the lows. Yields, but nonetheless, yields are down, and that means big banks are lower. We have the likes of J.P. Morgan, Bank of America, Wells Fargo, Citigroup down, modestly down, but again, as yields are lower. Now, the fears today, some of the risk-off tone, of course, has to do with the China crackdown and also the spread of the Delta variant. That's weighing on travel. If we take a look at American Airlines, Carnival, and Wynn, we see declines as investors, traders fret that there may not be as much travel. Wynn Resorts, of course, has their piece in Macau, China, so that's also down even more than the other travel. And then finally, if we round it out on a bullish bright spot, crypto absolutely soaring, Bitcoin rallying as real yields are in, plus the hint that Amazon may be thinking about getting into the crypto space. Technically, though, John, it looks like the rally that we have for Bitcoin right now might be short-lived. Nonetheless, you have a big, big rally for Bitcoin in the crypto space.
Abby, thank you. Bitcoin flying this morning. Coming up, Beijing expanding its regulatory crackdown, sending shockwaves through equity markets. That conversation next from New York. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The Chinese Communist Party is changing the way in which technology is invested in. You can see this with the way that they've influenced the Ant Group and Jack Ma, and then the recent DD flotation in New York. You're seeing a move away from so-called consumer-facing technology. This suggests that actually what the CCP is looking to do is to make sure that its own internal position is more solid.
China cracking down on private education companies, sending shockwaves through equity markets, investors grappling over Beijing's looming presence and tightening grip across a number of industries. For more, let's bring in Bloomberg's Kelly Lyons. Hey, Kaylee.
Hey, John. Well, these new rules from China are extensive. These private education companies no longer can make a profit. They no longer can raise capital, and they can't go public if they haven't already. Plus, they have to cut prices for their tutorial services, can't offer lessons on weekends or holidays. And our analysts here at Bloomberg Intelligence say that could mean some of these companies lose up to 80% of their revenue. That includes New Oriental and TAL Education, which are down about a quarter each in pre-market trading, as are the shares of Gaotu, actually down about 28% before the bell after after all three of these stocks got absolutely pummeled on Friday. And it's not just about these education names and not just about the last few sessions, John. China already has been cracking down elsewhere in the technology sector and on U.S.-listed companies, and that regulatory risk has weighed on sentiment. The S&P BNY Mellon China Select ADR Index down 24% year-to-date. The CSI 300 down by about 5.5%. Compare that to gains for 17 and 14% respectively for the S&P 500 and a benchmark of global stocks. So the point of the story is China has been dramatically underperforming, and that is true when you look at the different tech benchmarks as well. The NASDAQ 100 up around 15% on a year-to-date basis, while the NASDAQ Golden Dragon China Index and the Hang Seng Tech Index are down 16 and 12% year-to-date respectively. That Hang Seng Tech Index, John, celebrates its one-year anniversary tomorrow. It is down $550 billion in market value since its peak in February, so it's probably not going to be the happiest birthday, John.
It's been a tough time, that's for sure. Kelly Lyons, thank you. Let's just get to the pre-market and have a look at DiDi Global, the big ride-hailing company over in China. DiDi in the pre-market trading with a 7 handle. It IPO'd at 14. We're down by 10 percentage points in early trading. This was a company that tapped US capital markets for several billion and then all of a sudden faced a regulatory clampdown. There are so many questions about what they did know, what they did not know, and what they did not disclose to investors before they came public. And there are so many questions for investors, US-based, looking to get exposure to China. Allow me to bring in Esty Dweck, Michael Purvis, Keith Lerner. Esty, I'd love your view on what on earth is going on and whether any of these names, any of these themes are investable when it comes to the mainland, when it comes to China.
I think the short answer for today is no, not yet. We really have a cloud of uncertainty that about how long this can last, how big the scope is going to be. Clearly, this is beyond just the purest tech companies that we've talked about. So there's really just too many questions and not enough answers at this point to think, let's go into China. Now, it doesn't take off anything from the long-term prospects or the attractive proposition that Chinese and EM equities make over a multi-year outlook. But today, I think there's just a lot of questions. We're seeing that the Chinese want to have this regulatory crackdown across a number of sectors. They're not worried about angering other countries, including the West. They really feel like regardless of what they do, they're seen as, the bad guy, so they might as well just use this opportunity and have this regulation bring in. They want to have a fairer and maybe flatter structure across a lot of these businesses. Yeah. And the question is really, how long does it last?
Esty, these are massive moves. Concentrated, as you point out so far, that pain is concentrated and more acute in single names and in one particular region. China. My question, Keith Lerner, and I think the question a lot of people would have waking up this morning and seeing some of these price moves, is there a transmission mechanism for this de-risking that you see in these single names in this one specific region? Is there a transmission mechanism where that pain can bleed out to broader equity markets? Is there a broader macro story at play here?
Yeah, I think it's already happening, Jonathan. The emerging market index, which is now, China comprises, 37, 38% of that index. The emerging market index relative to the U.S. on a price basis is at the lowest level since 2002. So think about that. That was, that decade was, the global industrialization, China coming on the stage. We've given back all those gains. And then the other question today is, they're rolling from one industry to the next, and they're also squeezing profits. One of the reasons why we downgraded emerging markets earlier this year was, one, concerns about this technology crackdown, but also the relative price trends had weakened. And, the long-term story, a lot of folks are really bullish on emerging markets. You have to be bullish on China to be bullish on emerging markets. And I will say that I think at this point, there's just more uncertainty, and it's not an area that we would be overweight right now.
In the short term, that's certainly the story. Keith Lerner, Esty Dweck, sticking with us alongside Michael Purvis. Michael Purvis will be bringing that big call, 4,800 year-end on the S&P 500. Very shortly. Coming up in the morning calls and later, will big tech report big growth? Wall Street's 5 largest companies gearing up for earnings this week. That conversation still ahead from New York. This is Bloomberg.
rise again.
Broadway's returning June.
Have you bought tickets?
He's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Live from New York City for our audience worldwide, 5 minutes away from the opening bow. Going into the opening bow this Monday, equity futures down about 6 on the S&P 500, negative a little more than 0.1%. Outperformance on a Russell now, positive 0.4%. Your Nasdaq 100 down about 19, negative 0.13%. That's the price action. Here are some of the morning calls. Let's kick things off this morning with a call this morning from the team over at Deutsche Bank. Upgrading the gap to a buy, $42 price target. The analyst seeing a path to improving profitability with volatile trends now in the rearview mirror. Next up, MoffettNathanson upgrading Dish Networks to neutral, $40 price target. The analyst calling it packed with AT&T, a game changer, lowering the company's risk of bankruptcy. And your third and final call, it comes from the team over at Wedbush, downgrading Lowe's to neutral, $210 price target. The analyst forecasting slower sales growth with consumer demand trends decelerating. That stock is negative a little more than 1%. Coming up, big tech earnings on net deck. Wall Street's largest companies preparing to report this week. That conversation is up next from New York City this morning. Good morning. Just ahead of the opening bell, we're off the lows on the equity market. Your trading week gets busier and busier as the week progresses. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
24 seconds away from the opening bell this Monday morning. Good morning to you. Going into that open, your equity market set up as follows. On the S&P 500 down 5, off by a little more than 0.1%. No drama here. The small caps bouncing back from losses early this morning, advancing there 0.5% on the Russell, up 11. There's the opening bell. Switch up the board and get to the bond market. What a week ahead we've got for you. Chairman Powell on Wednesday with a news conference and a Fed decision, a ton of tech earnings in between. Your bond market yields lower by a basis point off the lows of this morning and well off the lows of last week. 112.60 last Tuesday morning, the lows of last week. Yields just a little bit lower over the week, but almost higher on the week after Friday's move briefly. 126.12 on 10s at the moment. Outside of that, euro strong, $1 weaker, euro dollar 117.89. Positive 0.1% on that currency pair, and crude down 0.5% to 71.72 on WTI. At a market desk with your movers, here's Abby.
Well, John, beneath that relatively benign surface for stocks, we have big movers, especially as you would expect around China privately held education companies. You'll see that we have absolute plunge here. This is a continuation of last week. This, of course, as Beijing has instituted new rules for these companies that could reduce revenue by 80%. So this is not typically what you think about around going concern risk, but that's essentially what's happening, and it's extending into the likes of Didi and Tencent, and of course Didi itself more recently has come under a clampdown. As for where we have a rally, it's all about crypto. Bitcoin up more than 10%, having to do with falling real yields, plus Amazon getting into the crypto space perhaps, so you can see a big response for some of the crypto related stocks. And then finally, returning to the bit of risk off tone, we have travel under a little bit of pressure, but at this point mixed. Earlier under greater pressure on fears of the Delta variation. Not as much right now though, John.
Abby, thank you. With that story out of Reuters earlier this morning that the administration won't be opening travel and taking away that travel ban anytime soon. For this week, it is all about big tech and big tech earnings. RBC's Lori Calvasina weighing in.
This is going to be the pivotal week, right? It's crazy busy. We've got well over a third of the S&P and some of these, including some of these big tech behemoths. So far, we've actually seen some resilience in areas like technology and growth revisions generally, while we've really just continued to see continued slippage on the financial side. So I really want to see this week if we're going to get confirmation of that trend.
To borrow that line there from Lori Calvasina, it will be crazy busy. Kelly Lyons, it will be.
I can't wait, John. Tesla kicks us off after the bell today, followed by Apple, Alphabet, and Microsoft tomorrow, Facebook on Wednesday, and then Amazon on Thursday. 6 companies that represent $10 trillion in market cap, roughly a quarter of the S&P 500. That is a lot of weight getting set to report. And of course, these stocks all demand incredibly rich premiums, John. Tesla kind of in a league of its own, trades at a forward PE multiple of 127, but the other 5 on average trade at 33 times forward earnings. So that sets the bar quite high. The question is, can these companies deliver, especially considering the headwinds that they face, ranging from China tensions, which of course are in the spotlight today, labor shortages and supply chain issues. Those could be particular issues for Tesla as well as Apple. But there's tailwinds to note as well. These companies have benefited in a massive way from the work from home world. That isn't necessarily a story that is over even if it is evolving. So what that will mean for demand for these companies and their goods and services will be interesting to see. And of course, John, broadly speaking, we have seen this market rotate back towards stocks that do better in a slower growth environment, out of the cyclicals, back into some of those safer haven trades like big tech. So we'll see if these earnings just exacerbate that trend, John.
Kelly, thank you. Thank you very much. What a week we've got lined up for you on the earnings front. Blackstone's Jonathan Gray saying strong earnings could potentially power the economy ahead.
GDP may be peaking just because we're comparing against much lower levels, but the question really is, are company earnings peaking? And we don't think that is the case. We think there's a lot of momentum in the economy.
Still with us, I'm pleased to say, is Esty Dweck, Michael Purvis, and Keith Lerner. Michael, I promised that we'd return to you on this call of 4,800. Walk me through that and the factor that these big tech numbers will have within that call.
Well, first of all, John, on the broader market here, you've got big tech, 40% of the S&P 500 there. I took my 4,250 up to 4,800 a week ago, and the way I look at it is that if we had a 2018 style Fed, it may not be so bullish here, but if the 10-year Treasury rate is going to hover, call it 1.2 to 1.6 or 1.7, but with the likelihood that it's going to be roughly in those ranges over the next couple of years, which is my view, you have a lot of inherent Treasury rate stability. it puts all the more focus really on equity risk premium as sort of the key valuation metric, and not so much on traditional PE multiples, or at least to be looked at in tandem with PE multiples. So if I see earnings growth next year, calendar year 2022, I think consensus per Bloomberg is around 210, 211 or something like that, 10% earnings growth there. You look at 4,800 at the end of the year, I think you could easily support an equity risk premium, a healthy equity risk premium north of 3% if the 10-year hangs in, even 20 or 30 basis points above where we are right now.
Yeah.
There, and I think you have to remember that the nominal earnings yield is really pretty compelling today, and I think it will be at 4,800, assuming that we still get the sort of a high single-digit earnings growth trajectory into 2022 and into 2023, which I think is quite probable given that nominal GDP is so strong and given that big cap tech is quietly going to continue to grind it out over
those
the
earnings,
next,
Mike, they've been doing more than grind it out, that's for sure. When you look at some of the growth that some of these big names have delivered, and Keith, you've made the point, the gains we've been seeing has been delivered by the earnings, not by margins.
That's right, Jonathan. I think something that maybe is not appreciated that much is all the price gains for the S&P since last June has been earnings driven. The PE is high, but it stayed at an elevated level. And even this year, the PE for the overall market has actually contracted. The other side is that we've been saying really since last year that earnings are underappreciated, that coming out of this cycle, learning from the last cycle, companies would be leaner and meaner than ever. And what we're also seeing right now is record profit margins. We're seeing strong revenue beats. In fact, the margin beat, Jonathan, for this quarter for earnings so far is about 19%. That's about triple the average. So as long as the economy moves forward, which is our base case, we think the market still has upside. The momentum is actually a good sign, Jonathan. We've tested and said, if we close up this month positive for the 6th straight month, how does that look a year later? And a year later, you're up double digits with about an 86% hit ratio. So again, we're looking at the weight of the evidence. The weight of the evidence is still positive. It's going to be a little bit choppy, but we think the direction is upward.
The argument I hear from all three of you is that the direction is upwards, that you should stick with risk assets, risk markets. I guess my question is, where? This is what Goldman's David Kostin had to say going into last weekend. He said, quote, vaccinations, equity demand, and attractive relative valuations will support prices. We recommend tactical positions in virus-exposed cyclicals alongside longer-term investments in higher quality secular growth stocks. Feels like a barbell approach there. Esty, I just wonder what your approach would be to exposing yourself to risk right now, where you take that exposure.
It would be very similar, actually. I do think there's more potential for these cyclical sectors. So we still like financials, energy, materials. They should catch up or regain, I guess, their leadership as data remains very strong. And I agree, growth is going to hold up. At the same time, and we've said this throughout the first half of the year, don't dismiss tech. You see the earnings, you see the growth and the sustainability of those earnings. So it continue to have some of those tech names and some of those defensive in the portfolio. As growth slows a little bit, even if it remains at high levels, those are going to be sectors we want. So I think a barbell approach makes sense. And a buy-the-dip approach continues to make sense as well.
Let's talk about what would test that. And I'd love to stress test this with you, war game things out. There was a headline that crossed the Bloomberg about 10 minutes ago. It said New York City expected to extend the vaccine mandate to all city workers. That according to NBC. I just wonder how you'd all respond if, one, we saw a mask mandate reintroduced for indoors for people, even if they had a vaccine, what that would mean for you for a risk stance, and even further, what it would mean if the headline crossed the Bloomberg terminal and it said the return to school was jeopardized going into September. What would it take, Esty, to knock you off course and rethink?
So there's, I think, generally very little appetite by policymakers for renewed strict mandates or lockdowns, and that's in the US and in Europe. The school is a challenge because if it does get pushed back, it can have an impact on the labor market and how quickly that reopens. We have heard that is one of the reasons why labor, didn't pick up as much as it could have over the last few months. But a mask mandate It has become a little more political in the U.S. We know some groups of people really don't like the mask mandate, but it's not that much of an effort to put a mask at a supermarket, at a pharmacy, at public transportation. It shouldn't impede on what you're doing. So it could slow the recovery a little bit. It could delay it a little bit more. What we're actually seeing is just more trying to get people vaccinated, because the more we get that vaccination, the less risk we have of hospitalizations and the less need there is for any of these stricter measures that really no one wants to see again.
Keith, what about you?
Yeah, similar. I think it does slow things down a bit, but I think it's going to take a lot more than that to knock us off as far as the economic trajectory. The other thing we haven't really talked about as much today is, inventories are so lean right now. So businesses have to spend money just to bring these inventories up. So I think that provides a bit of a buffer as a whole. And I will say, just because we're expecting things to be a little bit sloppier on the margin, where we were a couple of months ago was, all cyclicals. Our overweights right now are a combination of cyclicals and maybe quasi-defensive, but we have, real estate, which has both growth and defensive qualities, has a good dividend yield. The transportation, the transformation in the sector composition towards the digital economy is underappreciated, so we think that has upside. We have communications as a sector in tech that we like, quite a bit. Just made a new relative high on Friday. And then we still like energy and financials because they're just so undervalued. One point, John, I will bring up on the broader technology sector, we've been more skeptical there because this entire outperformance that we've seen the last 2 months has been all PE expansion relative to the market. So technology is now at the highest level relative to the broader market since 2008, and all this move has been PE expansion. So they really need to deliver this this week, and we're somewhat skeptical.
Keith, just quickly, you mentioned earlier that it was earnings and not PE expansion. Which one is it?
Well, it's for the tech sector specifically. It is relative to the broader market. It has been PE expansion. For the broader market as a whole, it has been earnings driven. But there is a distinction that, and this is a comparative basis between the tech sector and the overall S&P. The earnings momentum has not been as strong.
Keith, thank you. Final word, Michael Purvis.
With respect to ugly COVID headlines, it's like, you can go back and measure the impact on the markets of terrorist events or any sort of big shock, right? And the second time around, it just has less and less impact here. So I think it would take an enormous and frankly, a sustained level of ugly COVID-related headlines to really get, the VIX really excited again. March 2020, everyone was caught off guard there. No one really could get their arms around that. Yet the VIX go to record highs. I think it's very different now. And again, if a COVID cloud suppresses some growth, it's probably going to end up actually pushing some and deferring some growth into 22 and 23, sort of smoothing the the GDP and ultimately the earnings streams into those years, which is what equities need to see. So I think I'm not worried about that.
Michael Purvis, Keith Lerner, and the wonderful Esty Dweck sitting with us and staying with us. Your S&P 500 into Monday, 4-day winning streak, slight move lower on the S&P 500 right now, down by 0.05%. With your movies at the market desk, here's Abby.
Yeah, John, in contrast to that flat S&P 500 and U.S. equity indexes, we have China tech shares absolutely plunging. One tech index, China tech index, now down 15% over the last 3 days, the worst 3 days since 2008. This has everything, of course, to do with the crackdown out of Beijing on private education, but you see it extending to the likes of Alibaba, JD.com, Baidu, One Tech ETF, and of course, the high water mark for all of this might have been the halting of the Ant IPO last November. So lots of pain there. And in fact, if we take a look at the NASDAQ Golden Dragon China index over the last few months, in fact, from its all-time high, down 45%, really getting pummeled. The question is whether there's contagion risk to U.S. equities at some point. As for some of those big tech movers that you all were discussing, you can see mixed moves here ahead of Tesla reporting tonight, Apple, Microsoft, and Alphabet tomorrow. And it's very interesting. Not only do you have that high bar, the valuation to think about, John, these companies put up fabulous blowout quarters in the first quarter, but the stock sold off. It'll be interesting to see what comes out of this week.
Abby, thank you. Coming up on this program, we head down to Washington, D.C. Senators racing to finish infrastructure negotiations before breaking the summer recess. That conversation coming up next from New York. This is Bloomberg.
up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Infrastructure bill to pass, but we all know that more needs to be done. I hope that it will pass. I won't put it on the floor until we have the rest of the initiative.
Speaker Pelosi saying the House won't advance the bipartisan infrastructure package until the Senate also delivers a larger Democratic spending plan. Senator Rob Portman firing back.
What she has just said is entirely counter to what President Biden has committed to and what the Senate is doing, which is a two-track process. The infrastructure bill has nothing to do with the reckless tax and spend extravaganza that she's talking about.
So let's work this out. Down in Washington, D.C., Bloomberg's Emily Wilkins joins us now for more. Emily, what's happening?
Well, let's just break down that interaction there that we saw with Pelosi and Senator Portman. I mean, look, if Pelosi was to try and move on this bipartisan infrastructure package, which, by the way, we still don't have a full agreement on yet, there are members of her party, the Democrats, who have said that they will not support it unless Democrats move that larger $3.5 trillion package. But right now, Jonathan, the question is really in the Senate, in this bipartisan group of negotiators. Portman also said that they were about 90% of the way there. There are still outstanding issues on water, on transportation, on different types of funding, and exactly what percentage of funding should go to various things. This is really the week for lawmakers, for the senators. I mean, they still have another week after this before they leave on their August recess, but this is the one where they initially told Majority Leader Chuck Schumer, hey, we'll have it done by Monday. Now it's looking like it might be later in the week, and there's just a big question on whether or not they're going to have something. And if they don't, will Democrats decide to just back out of the bipartisan discussions and potentially go it alone, putting infrastructure into that Democrat-only reconciliation bill and going from there? So I think this week all eyes are on the bipartisan group. Can they actually come to an agreement? Can we see the legislation? And can we actually start the process of moving this bipartisan package through the Senate
and then to the House.
Emily, thank you. Down in Washington, framing the debate for us. Back with us for a final word is Esti Dweck, Michael Purvis, and Keith Lerner. Esti, can you walk me through the realistic range of outcomes that you're expecting down in Washington?
So we're still optimistic that some kind of bipartisan agreement will come through. The fact that some of the Democrats have said they won't bring it to the floor unless there's a separate reconciliation bill is likely to prove a hurdle for a lot of Republicans, as we've heard. But there is appetite for infrastructure on both sides. So I think the probability that they manage something is still relatively high. Then, in terms of reconciliation, I don't think 3.5 trillion is likely. Some of it can depend on if we get the bipartisan deal or not, but probably 2 trillion is closer to what we might get. And maybe here we have markets that underestimate a little bit the probability that taxes are going to go up with a reconciliation bill, because Biden is really keen on this and hasn't forgotten about this promise.
Yeah, it's a really good point. Keith Lerner, just a final word on that to you, sir. Is there anything coming out of Washington that you think can delay the return to trend growth in America?
No, I think the economy is pretty on a self-sustainable pace. Right now, as I mentioned, you got inventory is low. You have a lot of excess cash. Credit delinquencies are very low. In fact, Jonathan, what's really interesting is the debt service ratios are record lows right now. So the consumer is 2/3 of the overall economy. I think we're on good footing. Corporations are flush with cash. I think we're going to see more M&A, more buybacks, more CapEx as well. This would help out, but also these are big numbers, but they're spread out over several years. I do think there's a risk that if the Democrats go it alone and the tax conversation comes back, I do think that could lead to a little bit of a pullback in the market, but not change the primary trend, which is still higher in our view.
Michael Purvis, you get the last word, sir.
Yeah, no, I would agree with Keith. I think you have to be measured about, if we do get a big package announced, that the deployment, the stimulative impacts of that are really kind of deferred over a broad time frame here. So not to be necessarily too carried away by what gets announced if something is big is announced. I think the other thing, we have to remember, like, the midterms are only a year and a couple of months away now. They're going to come into sharp focus here, and that could have a very big impact on how people consider interest rates and the Fed and all that.
I think they already are. Michael, good to catch up, sir. Michael Purvis, Keith Lerner, Esti Dweck, thank you very much for being with us through much of the last hour. Your equity market on the S&P 500 unchanged, dead flat with your sector price action. Here's Dave.
Yeah, pretty even split among the 11 main industry groups, John, when you go through the S&P 500. Energy stocks clearly the best performers on the day, real estate the worst performers, and consumer stocks, not a whole lot of direction there, and that's in part why we're not seeing it in the broader market either. One thing that's interesting, if you go through the financial stocks, which are among the shares that are higher in early trading, the biggest gain, the biggest loss are tied into the same deal. Aon shares rising after the company decided to call off a $30 billion takeover of Willis Towers Watson, and Willis's shares, the biggest declines. And when you look at insurance brokers as a group, there are 4 of them in the S&P 500. Peaked in May, has been working its way back, though, and the group actually hired today in response to the collapse of this deal.
Dave, thank you. Our stocks editor. A busy week coming up for you, sir. Dave Wilson. Up next, your trading diary from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Bloomberg.com webinars.
Wednesday, the Fed decides. How worried are they about inflation? What will they signal about tapering? Coverage begins at 1:30 p.m. Eastern on Bloomberg Television and Radio.
At 25 minutes in, it's a quiet one to kick off the trading week this Monday morning. Unchanged on the S&P, unchanged on the Nasdaq, advancing about 6/7% on the Russell, going into a really big week ahead. So let's get to your trading diary. Your week ahead shaping up as follows. New home sales at the top of the hour, then the Treasury auctioning 60 billion in two-year notes at 2 p.m. Apple, Alphabet, Microsoft on Tuesday, a Fed rate decision coming on Wednesday, and finally personal income and spending numbers rounding out the week on Friday. Amazon, I believe, delivers numbers this Thursday. From New York City, ahead of a busy week ahead, that was the countdown to the open. Thank you very much for choosing Bloomberg TV. Continue the conversation at Fero TV for our audience worldwide. This is Bloomberg.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around, and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing that I mentioned and you carried on talking and ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are
the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease beside disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like